Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Let's get to the three things that you need to know today, starting with the markets. Stock futures are relatively flat after a mixed inflation reading. Wholesale prices came in a bit hotter than expected on a monthly basis in August, but on an annual basis, the number is in line with expectations and has cooled significantly from July's revised level. Initial jobless claims, though, ticking up slightly last week, coming in above estimates. The data comes as more investors price in a 25 basis point cut from the Fed later this month.
Nvidia leading AI stocks higher. The chip giant is back in favor on Wall Street after CEO Jensen Wong touted, quote, incredible demand for its Blackwell chips.
It's so great, and everybody wants to be first, and everybody wants to be most, and everybody wants to be, and so the intensity is really, really quite extraordinary.
Nvidia is just below the flat line in pre-market trading, but it did close up 8% yesterday on Wednesday.
And Boeing faces the threat of a strike as 33,000 union members head to the polls to vote on a critical labor contract. The chief executive, Kelly Ortberg, is making final pleas to avert the strike, saying it would put the company's recovery in jeopardy here. Boeing has been struggling to come back from a series of manufacturing incidents, including one in January when a door plug blew out on an Alaskan Airlines flight. The current labor contract was reached in 2008 after a 2-month strike, and the tentative agreement includes a 25% wage bump over 4 years.
We've got 28 minutes to go until the opening bell. You're looking at a mixed picture when it comes to the major averages. Now this move on the heels of the jobless claims report that we just got and the latest inflation reading with PPI out just about 30 minutes ago. You are looking at Dow futures on track to start the trading day in the green just above the flat line. That is also the case for the S&P as well. When you take a look at the NASDAQ 100 futures, that is trading just to the downside here, giving back some of those gains that we certainly saw yesterday. I also want to point out some of the action that we're seeing in the bond market, because this is really as important to note here. We are seeing a rise in prices, meaning some pressure on yields, and the significance of this is this really shows that the bond market might be paying a bit more closer attention to the labor market than it is that inflation print when it comes to claims out this morning. So something to note here in today's trading action. Also, when we flip over to some of the action that we are seeing on an individual basis ahead of the open, I want to point out to the strength that we saw in technology yesterday. That really was the reversal that we saw following the CPI print yesterday. A lot of that on the heels of the much more bullish commentary from Nvidia CEO Jensen Wong. We saw Nvidia close up today up just about 8%. Here we are in early trading. We're not trending too far from the flat line, up just about 0.2%. But again, when you take a look at the broader tech space, a bit of a mixed picture. You got Microsoft just below the flat line, as well as Amazon, Apple, and Google, not drifting too far from the flat lines. Meta, that is the case there as well. Take a look at the sector action here this morning. We are looking at some gains almost across the board. When you take a look at communication services, energy, utilities there leading the way as of this morning. A bit of a bounce back here from energy, so a bit of a reversal from what we saw yesterday. So again, important to keep your eye on here today.
All right, let's talk about Nvidia as well here. Shares are relatively flat in pre-market trading after closing higher by 8% on Wednesday. The surge coming after CEO Jensen Wong touted the extraordinary demand for AI chips at the Goldman Sachs Communacopia and Technology Conference on Wednesday.
Demand is so great that delivery of our components and our technology and our infrastructure and software is really emotional for people. Because it directly affects their revenues, it directly affects their competitiveness.
Wong pointing to the intensity of the demand being so great that their customers get emotional when the supply can't always meet what they want here. And that demand has certainly benefited Nvidia to this point. And some of the entrenchment that they've been able to put forward for themselves has really come back to CUDA, which we've talked at length with several analysts about. Stacy Rasgon, one of them we've talked about CUDA with, and how that compute unified device architecture, what it stands for, how that's really been part of the thesis around NVIDIA. But then you start to think about, okay, if NVIDIA is unable to meet some of that demand, who are some of the other players that could win or at least take some market share in the near-term period? Is it competitors like AMD? They have a company that they bought called ZT Systems, helps bring in systems expertise. It was kind of an engineer acquisition, but all these things considered, an acqui-hire as some people would call it, all these things considered, it's looking at some of the other stock plays that could potentially benefit as Nvidia is trying the best it can to meet demand and where other players can at least pick up some of the chips that are falling off their plate.
Yeah, and I think that's exactly been the narrative surrounding Nvidia stock, right? Just the fact that they have such a dominant position right now. When you take into account the estimates here for AI growth down the line, the chip sector, exactly their role clearly critical here to the adoption of AI going forward. Nvidia is far from the only name in the game right now. Yes, they are the leader, but there certainly are other opportunities for some of those smaller players relative to Nvidia to chip away at that market share. But I think just taking a look at the move yesterday, the significance of an 8% pop on the heels of really Jensen Wong almost just reiterating what we've heard time and time again. Yes, he did say some interesting commentary when it comes to the fact that customers are a bit more emotional because everyone wants to be first when it comes to this technology. But the fact that he did once again reiterate that quote unquote incredible demand for chips also went on to talk about the fact that every dollar a company spends on Nvidia infrastructure could be turned into $5 in cloud computing revenue. And I think that almost validates some of the concerns that had been, or validates the initial euphoria that we did see play out within the AI trade, and almost puts to ease some of those concerns that we did have over the last several weeks when it comes to, I guess, how quickly some of these companies are able to make money when it comes to their AI investments.
Yeah.
All right, we're going to get investors' take on the chip demand picture. Later on this hour, we will be speaking with John Vinh. He's KeyBank Capital Markets equity research analyst. That's coming up in just about 30 minutes. Another big story that we're watching today, a crucial union vote for Boeing. 33,000 union members will vote on their first comprehensive labor contract in 16 years. Here at the latest is our very own Pras Subramanian. Pras, certainly a lot riding on this vote.
Yeah, big vote today, Thursday, for potential. If they don't pass it, they could go on strike on Friday. A decision can be made by the members, and the members are the people that have the final say, not the actual bargaining committee. And the head of Boeing's union said that we don't think the workers will actually accept this deal, but this is the best deal we could get. And looking at the deal here, what workers would get is a 25% pay raise over 4 years, $3,000 lump sum payments, and some contributions to their pension, to their retirement accounts, and the promise to build the next jet in their Boeing facilities. But the workers wanted a 40% raise over 3 years. They wanted traditional pensions, things like that. This is the kind of things that other unions have asked for too. And this is something that Boeing is concerned about, because they said that in a letter to employees, even though we're $60 billion in debt, we're offering what we say is the largest ever pay hike. We know it's important. We got to do right by workers. But as you can tell, Boeing's sort of against the 8 ball here. They have to actually service their debt, pay their workers, and also get their production back online.
So why is the union pressing their hands this time around then?
So last pay negotiation period, they lost a lot of concessions, and this time they say, hey, look at what the UAW is doing, look what Hollywood has done with their successful union negotiations. And there's a new Gallup poll came out recently that showed that union approval hit its highest since the 1960s at 70%. So they're pushing their advantage. The public is behind them in that sense. And Boeing isn't exactly a sympathetic character here, right? So I think that's sort of what's happening here.
And that kind of begs the question I was going for here. When it comes to so many issues facing Boeing right now, Kelly Ortberg, certainly there's no shortage in the list of issues and challenges that he has before him. But when it comes to how far, I guess, these talks have progressed so far, there certainly seemed like initial analyst reaction was that they were very encouraged by the fact that we might be able to avoid a strike. How disastrous could it be if we do see some sort of fallout that wouldn't be welcomed by Boeing?
There's been talk about, will this affect my commercial travel, me traveling, and that's not going to be the case. There's plenty of planes already out there, so there's already a backlog of planes already built, so probably not right away, but it could affect their earnings, could affect sort of their guidance for the next year and 2025. So we'll see how long a potential strike could be. But, talking about Boeing, a lot of analysts have said this in the past, they're not going anywhere, right? They're not going to go out of business. So it's sort of how fast can it be done, we'll see.
All right, Boeing shares down right now, pre-market by about 0.4%. Pras, we'll continue to watch these negotiations and this critical union vote here. Appreciate the breakdown. Also, everyone, August producer price index data coming in slightly hotter than expected on a monthly basis, while July's data was revised to the downside. Meanwhile, on the employment front, weekly U.S. jobless claims coming in at 230,000. That's above the estimate for 227,000. Joining us now to break down what this means for the Federal Reserve and the economy, we've got Ryan Sweet, who is the Oxford Economics chief economist. Great to have you here on set with us today.
Oh, thank you for having me.
Absolutely. So, let's break this down because it's more than just these data points that we're getting here today on Producer Price Index coming after we got CPI coming in largely in line with expectations earlier this week. And then, of course, thinking back to the employment situation last week, that really sent the market into a little bit of a tailspin, it seems. So we're getting a little bit more pulsing news from at least jobless claims at this juncture. But how much does that move the discussion for the Fed at this point?
Not too much, but initial jobless claims is my favorite economic indicator.
Yeah.
Outside of hurricanes and strikes, it typically doesn't send false
Why
signals.
is that?
Because it provides a pretty quick and real-time look at the state of the labor market. And the key catalyst or the causal relationship between a rising unemployment rate and a recession are layoffs. And that's what jobless claims are measuring, the number of people that are filing for unemployment insurance benefits. And right now, they're still pretty low. They're below that break-even level, which is consistent with no monthly job growth. So I think this is a good sign for the Fed that, even though the labor market has risen, it's not because of a lot of layoffs. And I think that's an encouraging sign for them.
So then what does that tell us about the Fed when we do see some of the softening that we have seen in the labor market? Does it warrant Fed action?
Oh, it does. It's a
to
slam
what
dunk
degree?
that they're going to cut next week, and it's going to be 25 basis points in our view. I think it's going to be, there's not going to be any dissents. I think they're all going to be on the same page for the first cut, and then in subsequent meetings, it's going to be a little bit more of a lively discussion about whether or not they go 25 or 50. But they need to get this party started. They need to start cutting interest rates, kind of ease their foot off the brake to engineer this soft landing. On the inflation front, as you referenced with the PPI this morning, mapping it with the CPI, the PC deflator is going to come in pretty soft in August. And you don't want to ever say mission accomplished when it comes to inflation, but the Fed is very close to mission accomplished.
And so how does that set up, if we're close to mission accomplished, how does that set up what the pathway for those cuts might look like from your perspective?
So our current baseline is cut at every other meeting until they get back down to the neutral rate, which no one really knows where the neutral rate is until you get there. But I think the Fed can clearly lay out that we're going to be meticulous about cutting interest rates. They're going to pause if they need to with the inflation data, because one thing to look out for is that the comparisons get a little bit more difficult going forward. But in the end, if you look through the vagaries of the data, inflation's getting back down to their target in short order.
Ryan, it's interesting when you take into account, you were talking about how you love to look at, or one of your favorite indicators to look at is jobless claims. And we certainly have seen more emphasis on some of these, I guess, other prints than maybe historically had been speaking. And I bring that up because of retail sales out next week, following the CPI print that we got yesterday, and just some of the volatility that we've seen around some of these other prints giving us a better idea. Is there more emphasis, do you think, placed on next week's print when it comes to retail sales, and why or why not?
A little bit. I mean, the consumers, as the consumer goes, so goes the U.S. economy. But keep in mind that retail sales only makes about, 1/3 of overall consumption. Most of our spending for you and I is on services. So we get that data later in the month. But the retail sales is kind of like jobless claims. It gives you your first look at consumer spending in the month. So I do think the Fed will pay close attention to that. But every little wiggle in retail sales, you got to kind of take with a grain of salt.
And so with that in mind, going forward from here, assuming that we start to see some of the 25 basis points cuts and then additionally going out into next year, what the pathway for those cuts could look like, does that signal to you that the Fed feels like we're encroaching on recession territory, or that we'll be able to avert one in entirety here?
Yeah, so a recession is in our baseline forecast. The economy's in transition. We were booming over the last couple of years. We're creating 200, 300,000 jobs per month. GDP growth was well above the economy's speed limit. We're just now kind of in a transition period where we're settling into a more sustainable period of growth. And that feels uncomfortable. It feels like a recession to a lot of people. It feels like a recession to many industries, but it doesn't necessarily mean that we're in one. The interest rate sensitive parts of the economy, housing, autos, they've been taking it on the chin recently, but as the Fed starts to ease interest rates, housing should find its footing. So the interest rate sensitive parts of the economy should start to improve.
In theory, then, if you have more volume that comes back into the bidding for homes, or more purchasing activity that jolts up because of the mortgage rates becoming more favorable because of the Fed initiating some of their cutting, then wouldn't that mean housing would remain more elevated as part of one of the inputs in inflation for a longer period of time? And if so, then when would we finally start to see that abate? What would have to take place?
Yeah, you're right. So housing's been in the thorn in our inflation side, but that matters more for the consumer price index than the PCE deflator, which is the Fed's preferred measure of inflation. The housing market has been struggling. I mean, as interest rates do come down, we'll see more housing activity, but you kind of see a lot of housing disinflation that's in the pipeline. I mean, economists, we've been waiting for this. It's before it was like being a Cubs fan. Just wait till next year. It's coming. It's eventually coming. I'm a Red Sox fan, so I had to wait 80 something years. Okay, but
it's been a good run for the past.
Disinflation from housing is coming, but even just a little drop, some more activity in housing will do well for the economy. The other thing to keep in mind is that homeowners have a boatload of money built up in equity in their home. So as interest rates do come down, you might start to see some more cash out refinance activity, and that's good for consumer spending.
Ryan, real quick, two-part question here. One, if the Fed does go 50 next week, is that a mistake? Why? And then two, you talked about the fact that maybe some of the meetings that we will get before the end of the year beyond September might be a bit more lively in those discussions. What do you think would warrant a larger cut before the end of the year?
So I don't think it would be a mistake either way, as long as they cut. The Feds or the markets have been clamoring for a rate cut since the beginning of the year. Markets have been whipsawed by Fed communication, the evolution of the data. So if they go 50, I don't think that sends a signal to the market that they know more than we do. I mean, the Fed knows roughly everything that economists and markets know. So I don't think it would be a mistake. I think but they do need to get this process started. What would lead to larger rate cuts later this year is any further deterioration in the job market. So if jobless claims start to head up, get above 250,000 per week on a sustained basis, I think that's a red flag. If the number of permanent job losers is rising in the employment data, I think that's a red flag. So they're really kind of, they're not turning their back on inflation, but the labor market's taking a higher priority for them right now.
Very interesting, great insight. Ryan Sweet, good to have you here in studio. Thanks so much for coming on and joining us here this morning. Well, coming up, a quick look at some of Yahoo Finance's top trending stocks here ahead of the opening bell on Wall Street. You got the names up on the screen right now. We've got more when we come back.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, let's start with Kroger, lifting the lower end of its full-year comparable sales ex-fuel forecast as consumer spending on essentials, it remained resilient during the second quarter. Grocery store chains adjusted earnings per share. The EPS figure topped estimates while revenue fell short of expectations during the period. There you're taking a look at the actuals versus the estimates there, and you can see that mixed bag here. That's a shopping joke. But anyway, all things considered, I was looking through what the company is saying right now, because let's remember as well that this is a critical time for us to for them to track the closure of what's one of your favorite news pieces.
I knew this was coming.
In Kroger and Albertsons. I mean, this is the Shauna trade, folks. Kroger and Albertsons.
One story
together.
on it and it becomes your beat. But, well, yeah, I think when you take a look at Kroger Albertsons, exactly what's playing out in court right now. Kroger within this statement defending, obviously to no surprise, their planned acquisition here when it comes to Albertsons, talking about the fact that it's actually going to make the industry more competitive, allow them to compete with some of the other larger players out there when it comes to Walmart, when it comes to Amazon here. Again, that was the proposed $24.6 billion merger here for Albertsons that we're talking about, which is in court right now. But when you take a look at what is playing out in reaction in the stock price here this morning, a lot of this has to do with the spending patterns that we've been talking about time and time again here of consumers right now who are under pressure from persistent higher inflation, sticky inflation. They're then trading down. They're focusing on deals. They're focusing on value. It's something that Kroger's CEO also mentioned within this release that did give them a boost this last quarter here as people are still spending on their necessities. And as a result, they're looking past some of the weaker points within this print and focusing on where they did outperform. And that's a big reason why we are looking at shares up just about 1.5%.
Yeah, it's a great point. And one of the things that this kind of draws my attention back to, I was actually reading a report this morning from Deloitte talking about grocery shoppers and how they're craving convenience and fresh right now. Grocery retailers, they say, are working to navigate this new wave of change, challenging their conventional business models. Stressors, and if you're got your pen and pad out, these stressors are huge, emerging forms of competition. And that's not even just other players in the space. Sometimes it's the retailer themselves that's actually carrying the items, rising shopper expectations, tightening consumer wallets. Despite this, traditional strengths like fresh food, convenience, they play an increasingly important role in many consumers' purchase decisions. And that comes back to sourcing too here. And so we'll see how well the two things that you called out before we started talking about this, apples and potatoes, how they continue to keep doing.
Exactly. Yep. Both down prices. Yeah. Our prices are lower than they were a year ago. All right, let's take a look at the next trending stock here this morning, and that is Norfolk Southern. We're looking at losses of just about 1.4%. The railway company firing its CEO Alan Shaw for engaging in a consensual relationship with a subordinate. Now, Norfolk Southern's chief legal officer, with whom Shaw was said to have a consensual relationship, was also terminated. So what comes next? And that is a big question for investors at this point. When it comes to president and CEO effective immediately, that will be Mark George. The Street's quick first reaction to this, Bank of America's analyst Ken Hoexter was out with an immediate reaction saying that they actually believe the management transition will be seamless as the CEO or continues the operational overhaul, and the new CEO George provides continuity in the transition. So again, looking past some of the upheaval that we are seeing, at least in the short term. They also talked about the fact that Norfolk reaffirmed its full year 2024 targets provided on July 25th. So again, reasserting some of the outlook that we have gotten before. But despite all that, to no surprise, I don't think it could be a lot worse than it is here this morning with shares off just over 1%.
Yeah, I was talking about this one with, our executive editor, Brian Sozzi, who had interviewed Alan Shaw last year at the Invest Summit and really got a lot of his story, a lot of his upbringing. And, one of the kind of takeaways after hearing a lot of that is, all of that, it comes to a head at this point now with not being able to continue to carry on leadership in this position because of what's taking place as a result of these findings too, but also just the actions that he and the chief legal officer decided to take. All these things considered, Norfolk Southern's been incredibly embattled over the past 2 years here. You think about the defendant status that they've had in a class action lawsuit. They settled that for $600 million. They also have to figure out what to do with this compensation compensation too. I mean, $13.4 million compensation last year, and then additionally, there's a retirement compensation that he was supposed to be entitled to of about $9.6 million if he left the company. And so we'll see what this ultimately means for any of that compensation. I imagine shareholders will have a lot to say about that.
I don't believe, and I need to fact check this, but I don't believe he's getting the compensation because he was fired with cause. Yeah, not entitled to those compensation. But again, I got to fact check that, but I'm pretty sure.
No, thanks for that correction. I appreciate that. Guys, Moderna, let's also talk about this one. Moderna slashing its research budget in a push to reach profitability amid disappointing vaccine sales. The company plans to trim its R&D spending by 20% starting in 2025. And then after Moderna's pandemic era boom, of course, you'll remember diminishing demand for COVID shots. That has weighed on revenue projections. Back in August, Moderna cut its full year guidance, citing low vaccine sales and tight composition as well. They're implementing some portfolio prioritization, these cost efficiencies as they call them, stop me if you've heard that before, to reduce that R&D expense by about $1.1 billion from $4.8 billion in 2024 here. The new range by 2027, $3.6 to $3.8 billion is what they're looking for that to come in at.
Yeah, I mean, and I think when you take into account what the street has wanted to see here from Moderna, they wanted them to cut costs. They wanted the company to kind of realign going forward, given the fact that they have seen some of that weakness here, especially on the heels of what they saw revenue-wise coming out of Europe when it comes to weaker than expected performance from their COVID vaccine. Again, so they're making some of these strategy changes, cutting their budget by about 20% over the next 3 years, looking to find that path to profitability, very similar to what we've heard from analysts here over the last couple of quarters. Jeffrey's out recently saying that Moderna needed to cut as much as actually $1 billion in expenses to, quote, regain investor confidence. So again, a move like that, you could argue, could help regain some of that lost confidence here.
Yeah, they say looking ahead to 2026 and 2028 here, Moderna is going to be expanding its commercial portfolio. First-in-class vaccines, they say, therapeutics to address non-respiratory diseases, including, and my goodness, this is a word here, science, cytomegalovirus, I believe is what it is, neurovirus, propionic, I'm not even going to go further
I'm impressed that you're even giving this a shot.
Hella science they're doing over there at
lots
Moderna.
Of science, lots of research. All right, keep right here on Yahoo Finance. We got much more coming up. The opening bell on Wall Street. Looks like we're going to see a mixed picture at the open with the NASDAQ futures on track to open the day just slightly to the downside. We'll be right back.
Cytomegalovirus. There's a live look at the opening bell, and we're taking a look at the NYSE to kick things off. You've got Palmer Square Management ringing the opening bell there. Palmer Square Capital Management, ringing the opening bell there. And then you've got X-Charge with the funfetti, tossing it up like LeBron James before a game. All right, there you're seeing the bell ringers this morning. Let's take a look at the futures. Well, not the futures anymore. The futures were mixed, but now as we begin today's trading activity, let's populate this chart for you. Dow Jones Industrial Average right now, flat just barely to the downside here. We'll give you a 3-day look just to show you how things have been going and faring over the course of this week. As of right now, flats to start today's trading activity. But here on this Friday's Eve, you're actually seeing a full week view, and over the past 4 days, trying to hold on to some gains here. The NASDAQ composite, you're seeing that flat but barely to the upside to begin today's trading activity. But as of right now, past 4 days, solid move there. Little rebound or a dead cat bounce, whatever you want to call it. Just call it higher. S&P 500, you're seeing that over the past 4 days as well, holding on to some gains. Flat out of the gate, though. Let's take a look at some of the heat map activity here as we're taking a look at the 11 sectors in the S&P 500. You've got some laggards, more gainers, though, than laggards as of right now. Technology, though, pulling up the caboose. It's down by about 0.5%. But leading the charge, take a look at communication services. It's up by about 0.7%. Hey, since I mentioned technology, let's just take a quick look at the NASDAQ 100 here. You got a little bit of a mega cap tech slip up right now. Nvidia is down by about 0.7%. That was seeing some gains pre-market. We've erased those. We're now beginning the day in negative territory here. And we'll give you a larger look at Nvidia. Let's say past 5 days. Why not? Still up by about 8% over that period of time. And then, of course, as you're taking a look at the broader month to date for Nvidia as well here, well, that's essentially, actually, that's past 30 days. It should be 22 days anyway, up over that period of time, despite that little dip. Okay, that's a look at tech. That's a look at all the sectors here, Shauna.
So look at what we need to know here as we get started with the trading day. All right, Brad, let's talk a little bit more about that inflation print that we got out this morning. The PPI data showing a slight uptick in inflation on a monthly basis. However, the Fed does look on track to cut by 25 basis points at next week's meeting. Here to break all of this down, what the data is telling us about the Fed's next move, we want to bring in Brian Seitel. He is the Bahnsen Group's Senior Managing Director and Partner. And we also have Omer Sharif. He's the founder and president of Inflation Insights. Omer, let me start with you. Just in terms of your reaction to the inflation number that we got out this morning, not necessarily a huge surprise given the uptick that we saw, a slight uptick in the month over month on CPI. But what does that then tell us about PC and ultimately where the Fed is in its fight to tame inflation?
Yeah, good morning. So a couple of things about this number. As you said, relatively benign for the most part. Final demand PPI was about 2.1% last month, dropped to 1.7% this month. So really what we're seeing is benign pipeline pressures. And you mentioned the CPI yesterday was a little bit firmer than we'd like to see. It was about 0.3. But the good news is when you take that CPI data yesterday and what we saw in the PPI today, that combines to really make up what we get in the Fed's preferred core PCE. And right now, that looks like it's tracking at about a 0.1, maybe a very low 0.2, depending on a little bit more information we need tomorrow, but much more benign than what we got out of the CPI. So quite frankly, I wouldn't be at all surprised once people kind of crunch these numbers, if you get a little bit of a move back talking about 50 basis points, given how benign this core PC is looking for the month of August.
Brian, is that the case? Should we be talking about 50 basis points?
Well, there's a 17% chance now that they'll go 50 basis points, but I don't think they will. But what I would want them to do is 50. I just don't think that they'll actually get there. I think 25 is what we'll end up getting unless something changes, and we're 6-7 days away now from that decision. So I think we'll get 25 out of this.
Why do you want 50?
I think if you look at the bond market, where 2-year yields are compared to Fed funds at 175 wide, I think the bond market is kind of crying out for a 50 cut, and I think that might be wishful thinking. I think that when you're starting at a Fed funds of 5.25, starting at a 25 basis point cut really doesn't do a whole lot other than telegraph that you're going to move in that direction. And so 50 would be a little bit more meaningful on what they're trying to accomplish. But again, that's what I would want, and I think they'll start with 25.
Omer, when it comes to, I guess, just your assessment of the economy so far. So here we are. It looks like overall, yes, the labor market's slowing. We certainly have seen a bit more emphasis on the labor market rather than inflation here over the last several weeks. Are you confident that we will see that soft landing? Has the recent data reaffirmed that narrative to you?
No, to put it in technical terms, I would say the recent data has kind of freaked me out a little bit. Quite. I mean, the labor market numbers last month I thought were pretty disturbing. I'm with Brian on the fact that there's always this concept of what we think they should do and what they will end up doing, but I agree that they ought to go 50 because the 3-month average of payrolls has dropped to 116,000 from about 160,000. That's a really sharp slowdown. And I think one of the problems is, we talked quite a bit about the narrowing in job growth. So we're seeing it really in government jobs. We're seeing it in healthcare mostly. And a lot of the other sectors not really adding a whole lot. Well, the problem is the 3-month average in terms of job gains in healthcare slowed by almost 30K through the month of August. We've seen all the downward revisions to last year of over 800,000. Some of that will continue and will continue to affect the data from April 2024 forward. So I think, even though we haven't seen claims really pick up, net hiring has slowed down quite appreciably. People may not be laying off a lot, but they're not really hiring either. And I think the other thing is we're pretty far from the Fed's own estimates of neutral. So, 50 to me would be a good step to start to get towards that. If policy works with long and variable lags, let's get moving here to make sure that we are able to achieve the soft landing and not kind of fumble at the 1-yard line here.
Where do you think that Omer sets the terminal rate expectations at if we need to get moving now?
Yeah, look, I think obviously if you go 50, people are going to start to expect a faster pace. I don't know that that's necessarily a bad expectation. I mean, I think the Fed knows that they're relatively far. You've heard Chair Powell's language has kind of moved from talking about how we're, close to restrictive, we're trying to feel it out, to very, clearly saying we are restrictive right now in terms of policy. So I suspect, somewhere around 3%, probably 2.5% to 3% is the range they want to ultimately get to. But I wouldn't be surprised at all if in the September SEP, if they do end up going 25, I suspect they're going to add in a third rate cut later this year, because again, core PCE right now is it's going to finish the year around, maybe 2.6%. That's lower than where they had it in their June SEP at 2.8. And don't forget, when they had it at 2.6 in March, they already had 3 cuts penciled in. So I think if they end up going 25, they're going to start to add in more cuts into the back end of this year and possibly into 2025 as well.
Brian, what's the environment then for equities, for stocks at this point? Is it favorable, or given some of the concerns that Omer was just laying out, I guess, should investors be bracing maybe for more of a downside risk?
Well, I think it depends on what part of the market you're looking at. I think part of the market is quite expensive and quite overvalued. And I think if you have growth that is going to slow, again, you can't really have a soft landing without data starting to look a little softer here. And so some of this stuff that we're seeing, it doesn't necessarily freak me out per se. But again, I think there's part of the market where it would, and that is more of bigger technology names that are just trading at higher valuations versus some of the value-oriented names, maybe some of the staples, maybe some of the defensive names out there, utilities, healthcare. These are more reasonably priced, and historically in a rate cutting cycle, these tend to outperform some of those other segments of the market.
That's gotten us back into the realm of thinking about growth at a reasonable price, Brian. So where are some of your favorite, as folks like yourselves, folks far more intelligent than me would call it, the GARPy areas of the market that seem attractive right now, if you're looking for perhaps the best play to see reasonably priced growth in your portfolio?
Yeah, I mean, I think, again, some of those names, whether either candidate gets into the office, I think there's a good amount of spending coming on the infrastructure side. And so I think you can look at some of those industrial names, which are in that sort of GARP area, the growth at a reasonable price in there as well. We like the energy space also, and financials as well. I think all of those, you can get sort of high teens to maybe those low kind of 20 multiple numbers out of those names. And I think those will do better than some of the 40 and 50 times, technology names.
Omer, looking ahead to next week, we got retail sales. I was asking our strategist this a similar question at the top of the hour. How closely are you tracking that, just given some of the recent weakness?
Yeah, that's going to be another important input in how we're thinking about things. I think in part because we've seen the savings rate decline to sort of below pre-pandemic type pace. People were generally flush with cash for the most part for the last couple of years. Wages were actually outpacing inflation in some of the lower income categories, but now we've seen the savings rate come down quite a lot. So we're starting to see credit card delinquencies pick up and things of that nature. So it's becoming a bit more concerning in terms of how much can the consumer really continue to power power the economy through spending. I think in my career, I've learned not to bet against the U.S. consumer, but that will be another important indicator to watch, just because it does look like things are starting, budgets are starting to get stretched.
Do not bet against me, the consumer. You have no idea how just easily I succumb to ads on Instagram and just purchase everything in sight. Brian Seitel of the Bahnsen Group and Omer Sharif of Inflation Insights. Thank you so much for taking the time. Appreciate it. Coming up, chip names pulling back to kick off the session. We'll discuss when Morning Brief returns.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Chip stocks, well, they're mixed this morning. AMD, Intel, and Qualcomm pulling back just a bit, but this comes after yesterday's rally. You can see Nvidia up another nearly 0.5% today, gained 8% yesterday. Some of that recent increased optimism surrounding the sector coming as CEOs in the industry tout strong demand.
The demand on it is so great, and everybody wants to be first, and everybody wants to be most, and everybody wants to be, and so the intensity is really quite extraordinary.
I believe this is a market that will grow to, $400 billion by 2027, which is huge. And it is an AI super cycle.
So let's talk about that outlook for chip demand here going forward. For that, we want to bring in John Vinh. He's KeyBanc Capital Markets Equity Research Analyst. John, it's great to talk to you again. Let's start with Nvidia, given the massive move that we saw in the market yesterday, closing out with an 8% gain. Lots of optimism surrounding some of that commentary that we got from Jensen Wong. Anything in there surprise you, or is it pretty much of the same and just reassuring some of those skeptics out there on the street?
Yeah, I think this bounce that you saw in Nvidia yesterday was probably, a recovery based on kind of an overreaction on earnings, right? Obviously, Nvidia just, recently reported earnings that kind of met and exceeded street expectations, but they kind of missed some of the higher buy-side expectations. So you saw a little bit of a pullback there. I think what really drove the recovery you're seeing more recently is that, Oracle came out, talked about very strong accelerating growth on the AI side. And they also said that their outlook for next year is going to result in a doubling of CapEx. So I think that's reassuring investors that the AI trade is not over yet.
Is Oracle, in that sense, the best non-chip AI play in the market right now?
I don't cover Oracle. I cover the semiconductor. So I would just say that, Oracle right now is one of the key important reads in terms of AI hyperscaler demand and spend going forward. Obviously they're off cycle, so they're giving us the most recent read on AI chip spend at this point.
I knew you'd had an extremely informed read in. I know you don't cover them, John. I just gotta, when we're on the topic, I gotta lob it into you and see what we come out with. But great insights as always. As we think about, though, for chips, who is best positioned to really kind of catch some of the overflow that Nvidia is not able to handle for themselves?
I would say kind of three names that we would throw out. Right now we think it's such a expansive market. We heard Lisa Su talk about it being a $400 billion market by 2027. The three names I would kind of highlight would be an AMD, a Marvell, and a Broadcom, right? So AMD, you're going to be, we think they're going to be the lead second source alternative on the merchant side. Marvell and Broadcom are going to be focused more on AI hyperscaler custom ASIC development. Obviously Broadcom owns the Google TPU franchise there, and they've got a pretty strong position. Whereas Marvell, you're starting to see them get some good traction in the market with AWS.
John, when it comes to some of the maybe lesser known names, Sirus Logic, I believe, is one of the names that you like when you talk about focusing on Gen AI and the further destocking process. Where do you see the value there?
Yeah, we like Sirus Logic. They're kind of a proxy for Apple. 80% of their revenues is Apple driven. And if you look at the opportunity they had for Sirus Logic, right, there is potentially a replacement cycle if Apple starts to really get traction with Apple Intelligence there. So you can start to see unit growth. And on top of that, this is a company that has demonstrated content growth on pretty much every single new generation of iPhone. So on top of unit growth, you also have content growth, and that compounds, and it's kind of a proxy and a play on Apple.
So with that in mind, I mean, as we're waiting for some of, especially coming from Apple, waiting for some of these generative AI features to really hit critical mass coming through either via operating system updates or other consumer technology, where do we still need to see a lot of the industry be built out? Where are some of the gaps that still exist where investors would be apt to pay closest attention to?
Obviously, everybody saw the Apple launch event the other day, and, I think they made some progress. But I think if you take a step back, I think the industry is still waiting for that kind of killer kind of AI app. And I don't know if we really saw it the other day. So I think, you're definitely seeing some progress. But I think the broader market is still waiting to see what that killer application is going to be that's going to drive potentially a replacement cycle in AI handsets.
What does that mean for the future of the data center? We've heard Nvidia talk about this, the possibility for 1 million chip data centers in the future. Oracle has talked about needing a data center to be powered by nuclear reactors. So the data center itself seems to be set for a massive overhaul. How much more spending, though, do you think needs to come on the front end of that from some of the very companies that are looking to play in this AI space?
I think in the near term, we think spending is likely going to be unabated. Obviously the debate and controversy is, when are you going to start to see the monetization models for all this AI spend? And you really haven't seen it yet. You are obviously seeing some pretty good growth, but what we look at in our perspective, at least in the near to medium term, at least going into 2025, is that all these AI hyperscalers are going to have to aggressively spend. The next generation platform that Nvidia is releasing, Blackwell, is going to basically lower your TCO by 30x. So if we're still waiting for that monetization model, operationally, if you're a hyperscaler, you've got to go with the lowest cost TCO solution out there until you get that monetization model. So we don't see any sort of let up in spend over the next 12 months here.
John Vinh, who is the KeyBanc Capital Markets Equity Research Analyst. John, always a pleasure to get some of your insights. Thanks so much for joining us.
Thank you.
Chip companies like Nvidia have benefited greatly from the AI spending boom. It's how they're able to more than double their revenue every quarter. But investors also want to see evidence of AI spend paying off more broadly. Here with the chart of the day, touching on just that, is our very own Catalyst co-anchor, Madison Mills. Hey, Maddie.
Hey, Brad. Thanks so much. So I'm going to pull up the chart of the day on the board here so that we can take a look at the hyperscalers here. You've got Amazon, Microsoft, Alphabet, and Meta in that group. This chart shows their capital expenditure quarter over quarter on AI. Just in the last quarter here, spending over $50 billion on AI alone. So the big question for investors, they're actually originally were looking at this spend as a positive catalyst for these stocks. Now they're starting to question it. They're saying, hey, is this spend going to get us anywhere? And that was the key question at the Goldman Sachs conference that I was at over the last couple of days here. We spoke with Kash Rangan. He is over at Goldman Sachs, and he said these are the cloud names that benefited greatly from spending a lot of money on cloud infrastructure, and they're going to have the exact same experience this time around. The last day of the conference, I went to a meeting of a bunch of different VC folks who all said that these are the names that you're going to see hockey stick moves in as we move out of this seasonally bearish time of year for September and October. You're going to see a lot of growth in these names. And guys, I got to bring this up because I was jealous I didn't get to talk about it with you while I was gone. That Oracle earnings call when Larry Ellison kind of went on a little bit of a rant saying he just doesn't understand the questions about the impact of AI. It's not a thing you can sell, but it's going to impact literally everything. And that is what companies like these are banking on moving forward.
And he's trying and hoping that he's going to get that message out there sooner rather than later. It seems like it's working.
It's working.
For now. You take a look at the stock reaction. All right, Maddie, thanks so much. Keep right here on Yahoo Finance. We got much more of your market action ahead. Again, just about 21 minutes into the trading day. You're still looking at, we're not drifting too far from the flat lines, although all three of the major averages now back in negative territory. You've got the Dow off just over 130 points. We'll be right back.
Time for our Stocks in 30, a look at the day's trending tickers in 30 seconds or less. Let's kick it off. 7-Eleven parent 7NI Holdings, the company rejecting a takeover offer from Couche-Tard for nearly $39 billion this week. But reporting from Bloomberg says that the Canadian company is considering raising its offer price for the Japanese retail giant. If a deal were to materialize, it would be the largest ever foreign takeover of a Japanese company here. Look, as long as we continue to get 7-Eleven free Slurpee days, I'll be fine whoever owns this, but we'll see if that'll be the case, and we'll see if this buyout offer moves forward.
7-Eleven Slurpee, such a throwback.
Yeah, July 11th, every year.
I know.
Yeah.
All right, let's take a look at General Mills agreeing to sell its North American yogurt business for just over $2.1 billion in cash. The move following a decision to sell its European yogurt business several years ago as the company turns its attention to growth segments like premium pet food, also organic snacks. Now that the company's CEO coming out with a statement saying that by efficiently managing our portfolio and sharpening our focus, it will allow the company to focus more on global platforms and local gem brands that have stronger growth prospects and more attractive margins. We know that the yogurt business have been struggling a little bit, or facing more competition, I guess is the correct way to say that.
Yeah, that's fair. Also, leaning into and watching shares of Diageo on the back of an upgrade at Bank of America. Analysts upgrading to buy from neutral as they say the worst is behind the stock, and there aren't many other compelling alternatives in the staples space here. Take a look at shares of Diageo. Right now, they're up by about 2% on this. And, as you're thinking about what this upgrade means more broadly here, the U.S. investment bank saying that their earnings momentum is gaining new impetus. Growth, looking forward to that and improving in the 2024-2025 financial year.
All right, we'll keep it right here on Yahoo Finance. The ECB, European Central Bank, cutting rates once again. We're going to dive into what this could signal for the Fed, potentially other global central banks around the world. That's all coming up next on Catalyst.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We're just about 30 minutes into the trading day. 3 catalysts impacting markets this morning. We've got inflation data, the ECB's interest rate cut, and Hurricane Francine pushing oil prices higher.
And wholesale price inflation came in slightly above expectations for the month of August. This after monthly core inflation came in a touch hot this week as well. And separate data this morning showing unemployment claims ticking up. How all of this could impact what we hear from the Fed next week.
And the ECB, the European Central Bank, cutting its deposit rate once again by 25 basis points as growth stalls in the region. Central Bank President Christine Lagarde emphasizing the need for more progress on inflation this morning. Take a listen. All right, we don't have that, but we will bring you that side in just a minute.
We will bring you that. Plus, oil prices are higher today as Hurricane Francine disrupts output in the Gulf of Mexico. Meantime, the International Energy Agency is slashing its oil demand growth outlook for the year, citing slowing consumption in China, and that is in part due to the uptick in electric vehicle use in that region. All right, but first, let's get to today's economic data here in the States. Not changing market pricing for Fed rate cuts too much. Right now, traders pricing in an 87% chance the Fed will cut by 25 basis points next week. We've asked experts about the Fed's path forward and what that's going to look like. Here's what they've had to say.
And for everyone who's asking for a 50 basis point cut, I think they should really reconsider the amount of volatility that would cause in short-term funding markets. It's just not something the Fed wants to risk.
I think a 50 basis point cut would reek of panic, and it's almost like we're totally behind the curve at this point.
The Fed funds futures are right. The chances are is that it's going to be a 25 basis point cut.
And Sean, I think it's interesting because you can talk all day about whether or not you want to have a 50 basis point cut, but the Fed has not really given any indication of that coming to fruition come next week. I mean, that jobs report did not come in with horrific news about the labor market. CPI was kind of meh yesterday. There hasn't been this horrible news that would get them to freak out and cut by 50 points so far.
There hasn't been, and that's largely been the consensus and really what we've been hearing from so many strategists and economists. Yes, we will get the one-offs here and there. Like we had Omer Sharif last hour, and he was talking about the fact he actually said the latest econ data quote was freaking him out just a bit. He talked about the fact that, yes, we have seen improvement on inflation, but that fight is not yet in the rearview mirror. Talked about the fact that we are seeing some reason to be a little bit concerned about the slight uptick that we have seen on prices, but also more so the weakening in the labor market. And I think that kind of illustrates how Wall Street and why Wall Street is still very split on maybe what the Fed should do here next week. And I think that was also illustrated in the initial reaction we saw in the bond market. We actually did see yields under pressure just a bit this morning. I think a lot of that was due to the fact that the bond market much more now closely following some of that weakness or the latest updates that we are getting from the jobs market versus inflation. So I think it's that kind of push-pull that we are seeing play out. And I think that's why there are some people, although the numbers are it's dwindling, fewer and fewer, that are still pushing for the 50 basis point cut. And then, of course, there's also the argument just beyond maybe some of the weakness that we are seeing today. If they don't cut now and they don't do a sizable cut now, then maybe some of the weakness that we could see down the road in reaction to that.
Yeah, and are we on kind of a knife's edge, right? Yeah. Is this a scenario where they might have missed the forest through the trees of each individual data point? And if they did, could we end up tipping over into a recession, which is not something that gives you a lot of warning signs. Typically, it just sneaks up on you just a little bit here.
All right, the ECB, the European Central Bank, today cutting interest rates by a quarter point. Its second reduction of the year. Now, the bank also trimming its growth forecast for the full year to 0.8%. That's down from the previous projection of 0.9%. Joining us now, we want to bring in Alberto Gallo. He is Andromeda's capital management co-founder and chief investment officer. It's great to have you here. So let's talk about what we're hearing from the ECB. Nothing too worrisome, just in terms of there was this fear maybe that we would get slight hawkish commentary. That would be enough to spook the markets. But I'm curious just your reaction to Lagarde and then stretching that out to maybe what we could see next week from the Fed.
So there's two messages from the ECB. The first one is that they don't want to pre-commit to a cutting path. There's a lot of extrapolation in financial markets about, after the first cut, about how many further cuts are going to come by any central bank, and they want to push back. And the second message is they see inflation as sticky. And normally this second message would not worry financial markets and bond markets in particular, but we have just seen data of sticky CPI in the US, sticky services inflation, OER, rent inflation, and also wages. Boeing renegotiated a 25% salary increase with its employees. And even in the Eurozone, these wage negotiations are, going above 5% year on year. So essentially the last mile of inflation is still very tricky and very sticky. And I think that central banks are right to worry and to push back against this. And probably we've got too many cuts expected, not so much for this year, but for next year. We've got, a lot of cuts expected, both in the Eurozone and also in the US. And I think bond markets are a little too hopeful here. We have to, at some point, trim back these expectations of, rates going back to 3% in the US and, 2% in Europe.
Well, I'm interested in the idea of the stickier inflation on the margins, at least in Europe, particularly because they talked about the growth outlook and seeing weakening growth moving forward. How do you have both of those at the same time? Can you explain that?
Unfortunately, that scenario is called stagflation.
Right.
It's not our base case, but in the US, the reality is stronger growth still there, and the US consumer is still pretty solid. If you think about what the Fed did, they hiked to 5%, but that interest rate is really the rate at which, unfortunately, only the bottom 25% of consumers is funding at. So essentially, people that use credit cards and auto loans are hit by that 5% interest rate, and that's not great. While every household that had, long-term mortgages, more wealthy households, are already funding at 2%. They have, they have these vintage mortgages, which are 2%. And the same for corporations. Microsoft and Google are funding at, old bonds that they issued at 1 or 2% yield when yields were very low. Remember, we had 15 years of low yields. So that 5% rate didn't really hurt everyone the same way. And as a result, 75% of the population and of the corporate universe are still okay despite that 5%. And at the same time, fiscal policy is very strong after elections, very large amounts of spending. We're talking about 7% or near there. That's the CBO forecast for next year. So in the US, I would say inflation is sticky because the economy is strong. In the Eurozone, inflation is sticky because of commodity prices and other effects, which are still dragging on that inflation number. For example, wage negotiations, commodity prices, supply bottlenecks. The UK is a case in point, but even in the Eurozone. And as a result, it's a little harder to go back to that 2%. But yes, the inflation problem in the Eurozone, I think it's not as large, and the ECB will cut later on in the year and also next year, but they want to keep some ammunition for emergency, which I think is wise compared to, cutting rates very, very deeply right now when the economy is still humming along, it's not in a recession.
Alberto, that's great insight and very important when we're trying to figure out or factor in some of the differences that are going on here in the U.S. and what's happening from a global standpoint. I'm curious just to focus, Alberto, on the U.S. For a moment. When it comes to the expectations and what the market is pricing in versus what you think is more realistic, is the market still too aggressive with what they are pricing in for rate cuts this year?
So essentially, right now, you've got bond markets pricing the world in a recession. So bond markets, until recently, were pricing almost a 50 bip cut in September next week. And we're going to have a 25 bip cut, but they're still pricing a lot of cuts into the year end. Another another 50 after the 25 we'll get next week. And then there is something like, 150 to 200 bips further cuts priced for 2025. So that's, returning to a pretty low interest rate level. And it requires a substantial slowdown in the economy. Are we going to get that slowdown? Well, a 1% Fed rate cut accumulated can create a bounce in GDP, can move GDP up to, 100 bips for the next 12 months. And then we have fiscal that's going to still be pretty large. So we see this rate cut path almost as a bridge loan that the Fed needs to give to the economy, in the interim period between, one administration and the other. But post-elections, we're likely to see, regardless of who wins, we're likely to see more fiscal stimulus. And, the latest polls suggest Democrats are in the lead, and that would mean, fiscals would mean higher taxes, but also fiscal handouts and spending that goes to that bottom part of the population that's been hurt the most, and that's inflationary. So it's very likely that next year at some point the Fed will say, "Hey, we've cut a lot, and now we need to pause." And no one is prepared for that. So bond markets are seeing the world with the recession lens, and equity markets are seeing the world, in terms of love glasses. They're not seeing any recession. So one of the two is wrong, and we think bond markets here are too pessimistic on the world.
Alberto Gallo, great to get your insight here. Thanks so much for joining us this morning. Andromeda Capital Management's co-founder and chief investment officer. Thanks, Alberto.
Thank you.
So check out the markets 40 minutes into the trading day. This is sponsored by Tasty Trade. We want to kick it off with the major averages because what we're seeing this morning is very interesting. It kind of changes obviously by the second, but it's a very different picture than what we were looking at the open. You've got the Dow and the S&P both in negative territory, although just off the lows of the session, you got the S&P trading about 2% below that July high that we saw. The NASDAQ now back in positive territory. We certainly did see lots of excitement following some of the commentary from Nvidia CEO Jensen Wong yesterday out at the Goldman Sachs tech conference in San Francisco, which Maddie, you were at. That added some excitement to the markets yesterday. A lot of those gains being led by some of those larger chip makers. But again, we take a look across the board, still a mixed picture. I'm flipping over quickly to the bond market as well. A bit of a reversal, but now we are seeing yields actually pushing to the upside. They have been under pressure just briefly earlier today. You have the 10-year yield slightly positive, up about 1 basis point to 3.66. So again, Treasury prices here under a bit of pressure this morning.
Yeah, certainly. I also want to check on the energy sector here. We're going to look at the XLE ETF, recovering a little bit after a couple of days of movement to the downside here, certainly over the last 5 days at least, been under a bit of pressure. But I really want to focus on this report from the IEA this morning, talking about demand for energy coming out of China weakening. China is typically the highest demand driver globally for oil, so that could certainly lead to a little bit of pressure taken off of prices for commodities. And I think it's fascinating, and we really can't talk enough about China increasing their demand for EVs in particular. That's not only going to impact the price of energy more broadly, but that's also certainly going to impact those EV names that we love to talk about, Shauna.
Certainly do. All right, we'll keep it right here. We're just getting started on Catalyst. Much more ahead. Now time for some of today's big stock movers throughout the day. Throughout the trading day, you can track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. Scan the QR code below to check out that latest action. Let's start with the automakers. General Motors and Hyundai are exploring their collaboration efforts, the two companies looking to create new vehicles and technologies in a bid to cut costs and also move more efficiently. Yahoo Finance's a senior autos reporter, Praz Subramanian, tracking those details for us. So Praz, what does this partnership potentially look like?
Yeah, they're exploring the ability to sort of jointly develop new cars and also new technologies like electric propulsion, batteries, hydrogen power even. It's kind of a big deal because GM, they've done this in the past. They've worked with companies like Honda and others in the past, but Hyundai hasn't. And this is the first time they've inked a big deal with a big legacy automaker. Kind of shows how far they've come. And both these automakers see that in the future they have to sort of work together and join resources together to kind of take on Chinese automakers who potentially have better cost efficiencies to make cars.
And it's interesting to me too, given what the story I've been obsessed with today is this news about oil prices being under pressure because Chinese citizens are spending more on EVs and they're transitioning away from traditional cars. To what extent does that story apply to something like this in terms of automakers teaming up because it's such a competitive environment out there?
Yeah, I think it makes a lot of sense in the EV world because of the fact that both automakers they're making gas-powered cars too, right? So they have to kind of invest in both technologies, and they say, you know what, why don't we join forces for EVs? Now, I spoke to an analyst that tracks sort of manufacturing in the automotive sector, and he says that both these companies have a lot of excess capacity with regards to making batteries right now because not enough people are buying EVs. So why not join forces there, use that excess capacity to sort of work for both companies, and then eventually you can probably expand as more people may go into EVs outside of China. In China, it makes a lot more sense, right? Mm-hmm. But here, I think they're kind of showing how do we cost effectively make cars. That's the big thing. How do we partner and cost effectively make these cars that cost so much, thousands of dollars to make each vehicle? So that's sort of why we're seeing these happen more and more.
Yeah, it's interesting. We're seeing a lot more partnerships of previous competitors across multiple industries right now.
Yeah, I mean, just last week we saw Toyota and BMW team up on hydrogen power. So it's all happening right now.
Yeah, absolutely. All right, well, Praz, we'll have you here to explain it all to us, as I'm sure this is a trend that's going to continue. Thank you so much. Appreciate it. Another trending ticker here. We're taking a look at Alaska Airlines boosting its outlook for the third quarter profit on strong summer demand and lower than expected fuel costs. You got shares of Alaska up about 0.3%. And this is interesting given what we got in the CPI data yesterday. We had seen a little bit of pressure on airfare costs, but that actually did tick back up in the CPI print yesterday. And we're starting to see that show up in the revenue streams of these airlines. It's not just Alaska, by the way. We also recently had JetBlue, I think, increasing their forecast moving forward. And you've got the entire basket of airfare stocks, airline stocks going up today, Shauna.
Yeah, certainly when you take into account some of those drivers or some of the tailwinds that we are seeing within the business, more specifically, a note from Citi caught my attention. He talked about the fact that the guidance was very encouraging, but he also went on to say that tailwinds related to a July CrowdStrike outage that impacted some of its competitors, along with that stronger performance in August and in September, are reasons to be optimistic on this name right now. So again, we are looking at some gains here in early trading off the highs of the session, but still up just about 0.2%. Let's switch over to another airline that we're closely watching, and that is Delta. It now expects full-year profit at or above its previous expectation of $6 to $7 a share. Now, this excludes a 45-cent impact from the CrowdStrike IT outage back in July. Clearly, Delta was hit very hard by that outage, very outspoken about the impact that it would have. We are seeing a bit of a negative reaction to the stock here this morning, off just about 1.5%. But again, we know that Delta was most severely impacted by the shutdown among the U.S. airlines. Revenue for the third quarter is going to be flat to up to 1% from a year ago, including an estimated $380 million reduction related to that outage back in July. Maddie?
Yeah, it's interesting. I think that the airline coming out and saying that its full year profit is going to be about $6.50 a share. That's kind of in the middle of a prior estimate previous to the CrowdStrike outage. So I wonder if as the market kind of digested this update from Delta, it's not seeming like the news is as good as previously anticipated. Because if you take a look at the stock movement throughout the day, when you were anchoring your show, Sean, I was taking a look and shares were up over 5%. And now they've moved down 3% and then now down just about 1.5% here. So interesting to see that kind of movement here. I do think, though, it is telling that we are seeing this updated guidance that has been positive across several of these airlines. It's indicative to me that, unfortunately for us, those airfare prices not necessarily going to break on those anytime soon. Well, moving to another story we're looking at here, a U.S. appeals court is holding oral arguments on Monday to hear challenges to a law that would ban TikTok. That is, if the U.S., if China-based parent company does not divest ownership by January 19th. The legal proceedings could determine whether the app would remain available for download here in the States. Yahoo Finance's Alexis Keenan has the details for us. Hey, Alexis.
Hi, yeah. So what this is on Monday is the lawyers for the Justice Department, for ByteDance/TikTok, they're going to get the chance to go before a judge, as is a party of users who have a stake in the game here. They're going to get to give their arguments to the judge so that the judge can weigh the arguments in the case. Now, if you go back, you remember back in April, Congress passed that law that said either TikTok, you divest to a U.S. owner, or it's banned in this country. Now, TikTok is saying that that law is unconstitutional. They say it's a violation of the company's right to free speech under the First Amendment, and they say it's a violation of their users' right to free speech under the First Amendment. They've also said that the parent company, ByteDance, will not allow for its algorithm to be divested to a U.S. company. That's really the bread and butter of the way that the app works. So the court is really going to have to weigh national security interests. That's the reason for this law. The DOJ, Congress has said it doesn't want China to have a hold over Americans' data that then could be used against them in some form. That's all Americans, including the U.S. military. So the court is going to look at national security against the Constitution. Well, TikTok's going to have one problem, and that is you can't assert constitutional rights on behalf of someone else. That has to be the actual party. They can't come in and say, well, they can come in and say it, that users' free speech is being violated, but it's not, they don't have a stake in that race, right? It has to come from users. On the other hand, foreign companies do get some constitutional protections, but it's a huge question as to how far the court will go, any court in the U.S., because there are U.S. companies that have been afforded a lot of protections under the Constitution, but a foreign company is a whole nother ball of wax. So a lot of novel issues here. The DOJ, for its part, has said, well, this is not really a ban. This is just a requirement to change owners and that users would still have the right to use the platform as they did in the past once it's under U.S. ownership. There's a lot of talk that this could go all the way to the Supreme Court.
Could this be swayed at all by the presidential election?
Yeah, absolutely. That was something I wanted to mention, without getting too long-winded, is another administration could choose to start negotiating with the company and have something different as a result than a January 19th ban if the company doesn't decide to play ball.
Yeah.
Very interesting. Very interesting, Alexis.
It could all change.
It could all change. And it could be a boost for the social companies if TikTok has to change in any form, right? So U.S. companies, Facebook, Meta, Instagram, Twitter, X.
Exactly. All right, Alexis, great job breaking that down. Thanks so much for covering that for us. Keep right here on Catalyst. We got much more coming up. Again, we have the major averages not too far from the flat line, but the S&P and NASDAQ now back in positive territory. The Dow, though, still negative. Much more. We'll be right back. Wholesale prices rising in August, about in line with expectations. That's a final inflation data point as the Federal Reserve gets set to lower interest rates potentially next week. The debate on Wall Street continuing ahead of that meeting, with strategists mixed on whether or not the Fed would move to aggressively enough. Let's take a listen.
And for everyone who's asking for a 50 basis point cut, I think they should really reconsider the amount of volatility that would cause in short-term funding markets. It's just not something the Fed wants to risk.
I think a 50 basis point cut would reek of panic, and it's almost like we're totally behind the curve at this point.
The Fed funds futures are right. The chances are is that it's going to be a 25 basis point cut.
So let's get another voice to weigh in on this debate. We want to bring in George Sees. He's Innodell Capital founder and chairman, joining us now. George, it's great to see you. So, of course, this debate has been 25 or 50, whether or not if the Fed does go 50, is that going to incite some panic within the market, just about maybe ultimately what that tells us about the state of the economy? What do you think?
Hey, Shauna. Well, they should go 50, but they're not. They'll go 25 because they're very cautious and they're very much incremental in the way they go about things, but they're behind the curve at this point. The economy is slowing dramatically, and we need a significant rate cut, but it's going to be incremental. It's going to be over time, and it's going to be 25 basis points at a time. So it's going to be slow and steady. That's the way the Fed does business.
George, what is it more specifically that's worrying you so much? Is it some of that softness within the labor market, or what other data points are you watching that has you really thinking that the Fed should go 50?
We've had about a 15-year upsurge in the stock market and the economy, and the Fed had a historically strong rise in interest rates the last 2 years or so, and they've been very slow to unwind that. And I think that the economy is going to keel over at some point in the next 2 years, and I think the Fed's going to be too slow in how they combat it. But that's the way they're going to fight it. They're going to be very slow because they're very cautious. So I think they're behind the curve, just like they were behind the curve on inflation and slow to raise rates when inflation rose so much. And now I think they're behind the curve in cutting it back.
So how do you position for that potential, not the most optimistic potential reality, George?
I think you go into things that are sensitive to interest rates. I think people have been really negative on banks and financial companies the last several days in the markets, and I think they're going to really benefit dramatically when the Fed starts cutting dramatically, which they'll have to do over the next 6 to 18 months. So I would go into financial stocks and interest-sensitive stocks and things of that sort. I would be hesitant to go into stocks that are really dependent on significant growth in the economy and all that, because I think the economy is going to slow dramatically. So I would go into interest-sensitive stocks currently.
Okay, well, I got to ask George then what you think about the tech trade.
Yeah, I think the tech trade is long in the tooth. I think it's been going on a long time, and I think that you saw the violent move to the upside in Nvidia yesterday after quite a bit of correction over the last week or two, and I think that people are fighting the trend, and the trend I think in tech is down. I think tech has had a long move, and I think it's not quite over yet, but I think it's pretty much over, and I would be really, really cautious on tech at this point.
George, when it comes to earnings have been stable. They've been holding up very, very well. When you take a look at the estimates here for the current quarter, we have seen a bit of a revision here to the downside. Does that worry you at all, or does that support maybe the point that you were just making, just in terms of that rotation out of tech and seeing opportunity elsewhere?
Yeah, I'm not too worried about it. I think the market's going to chop. I don't see any falling off the cliff or anything like that, but I think that it's going to get a lot harder going forward in the markets. I think that we've been spoiled by over 10% returns for quite a long time, and I think that's over. I think making over 10% is going to be really difficult, and you've got to be very sector specific in terms of trying to capture those kind of returns, and I think we've got to get used to lower returns. Subpar 10%, positive returns, but I think it gets harder from here on out for the next 5 years.
Absolutely. Well, it's interesting, George. I also want to get your take on fiscal policy moving forward. Obviously, whoever wins come November is going to have a pretty big impact on what the path forward looks like for fiscal policy. How are you positioning for the potential eventualities for either candidate, and how fiscal policy could potentially impact the path forward for monetary moving forward?
Yeah, that's a really great question. I think we have two very terrible choices, frankly, at the top of the ticket on the Republican side and the Democratic side from a standpoint of fiscal policy. There is no fiscal restraint. The government is spending too much money. We're running way too high deficits, and I don't see Trump or Harris showing any discipline in terms of reining that in. And we really have to as a country. Our debt is 35 trillion plus. Our deficits are close to 2 trillion a year, and we're not showing any restraint. And entitlements are going to bury us at some point. So I think we have two bad choices on that, and that's not a good thing for the markets. And I think that interest rates are going to go up eventually again, even though the economy is slowing down because our debt's so high. So somebody's got to get in power that actually focuses on that. And the two choices we have this election cycle are not going to do it, either one. So hopefully in 2028, we get somebody who will actually do something about this for the good of the American people.
George C., thanks so much for joining us this morning. Really appreciate it.
Thank y'all for having me. Appreciate it.
Well, we're going to stick with politics here. Vice President Kamala Harris Tuesday night reiterating her support for fracking in the ever-important swing state of Pennsylvania. Take a listen.
I will not ban fracking. I have not banned fracking as Vice President of the United States. And in fact, I was the tie-breaking vote on the Inflation Reduction Act, which opened new leases for fracking.
A bit of a change there. Harris was against the policy when she ran for president back in 2019. Joining us now to discuss, we've got our very own Rick Newman. Rick, I know that you have talked with us a lot about the potential policy shifts within the Harris campaign. What are you kind of digesting that this change could mean?
There are three big issues where she has changed her policy from 2019. The first is fracking, and that's energy more broadly. So she supported the Green New Deal in 2019, which would have been a massive government reach into the transportation and energy sectors. I mean, that was never going to happen, but she supported it anyway, and that included the ban on fracking. She supported Medicare for All, the giant health care plan that would cover everybody. That's Bernie Sanders' idea. That's no longer her policy. And then immigration. She has gotten much tougher on immigration since 2019. And I mean, none of this is really surprising. She has to update these policies because in 2019, she was kind of a pretend president. She was running. She didn't even make it into it was the 2020 election, but her campaign flamed out at the end of 2019. She didn't even make it to the first primary. And she was trying to win liberal votes, progressive votes, by sort of finding a niche between Elizabeth Warren and Bernie Sanders way over here, and then Joe Biden more in the center. It didn't work, obviously, but now she is campaigning to be the real president, and she's running in a general election where she absolutely has to get the votes of moderates and independents. So it only makes sense that she's adopting these more sensible policies. And so you can say she's flip-flopping. Yes, she is flip-flopping. All candidates kind of flip-flop. Trump has certainly flip-flopped. Voters could say, I'm glad she's taking these positions because these are actually much more sensible and more realistic positions that address what you have to do in the real world if you are the president, rather than you're just trying to win 20% of the most liberal voters in a primary election.
Do you think those centrist voters are going to trust her on this? Because then I would guess that there's a fear that she's just going to flop back to maybe to what her rhetoric and what her stances had been in the past.
I think that's a huge question, and that is what that's what the polls are trying to figure out. Is she getting those votes? We're not going to know if the polls are going to give us a good answer until Election Day. She is clearly trying. I mean, from a perspective of realpolitik, if you will, if she takes these positions, she can't get elected president and then suddenly say, oh, I was lying, let's ban fracking. I mean, if she wins the presidency, she's going to want to get reelected, and she's also going to want to help her party in Congress, and she just cannot be an extreme leftist politician and help her party and stay in office or win re-election. So, Biden, for example, when he was campaigning in 2020, he said he wanted to end fossil fuels. And then guess what happened? Gasoline prices hit $5, and suddenly he's flooding the market with oil from the strategic reserve. No, we're not going to ban fossil fuels. We're going to try to. Now he's asking, American companies to produce more. He's asking the Saudis, more oil, please. So, I think Kamala Harris was there for all that, and she's smart enough to have learned the lesson. Be careful what you say, because when the market turns against you, people are going to remember you said, let's ban this or that. Suddenly the price goes up. Voters clearly blamed Biden for rising energy prices, even though it really wasn't his fault. It had more to do with the Russia war in Ukraine and stuff like that. But they were like, Biden hates fossil fuels. Fossil fuel prices are up. It's his fault.
Very interesting stuff. You can check out more of Rick's latest column on yahoofinance.com. Rick,
Thanks,
thank
guys.
you. All right, coming up, as the NFL season is now in full swing, where are investors looking for opportunities in the sports betting market? We've got one top pick from one bank coming up next. Sports betting is on the forefront of many fans as NFL season kicks into full gear. But for investors, Flutter Entertainment, which owns and operates FanDuel, could be in a class above the rest. The structure of its parlay offerings, which if you're not familiar, it's a single bet linking together multiple wagers. They are returning higher premiums than their competition. Here with more and to explain this call is Brant Montour. He is Barclays Director of Equity Research of Gaming and Lodging and Leisure. It's great to have you here, Brant. Thanks so much for joining us. So talk to me about the fact that you think Flutter is a quote-unquote undisputed leader. Is it all because of the parlay bets, or what else is going into your thesis?
Hey, thanks for having me. So parlay is part of it, clearly, right? I mean, they've shown their ability to get a higher parlay mix than peers, and sometimes double the rate of their peers. They also hold better on those parlays, so that means that they're basically, you know, the same parlay or in their parlays versus their peers' parlays. They're withholding more winnings out of the handle that's ultimately staked. And so look, it's not easy to do that business. That business is incredibly complicated. It requires incredibly sophisticated technology and risk management and trading, and this is expertise that FanDuel has, leveraged from its parent company Flutter, and Flutter has built this technology and expertise over decades in international markets. So this is basically the outcome of a moat that Flutter has been building. Flutter, the parent company, has been building for a long time, and that's why it's hard for others to break into it. To the same extent, of course.
Of course. Well, I'm interested in this because I just went to a panel at the Goldman Sachs Tech Conference that Lachlan Murdoch was speaking in, and he was talking about Fox getting interested in sports betting, and the path forward for them is obviously a little bit of a longer road ahead, but that is their strategic plan moving forward. To what extent do you think that some of those well-known names that are media giants could come in and be significant competitors to a name like FanDuel?
Yeah, no, it's a good question. It's one we spent a lot of time on, right? Because we know that, there are other large players that want a piece of this market. ESPN with their partnership with Penn Entertainment and their launch of ESPN Bet late last year. There's big international players like Bet365 that have taken smaller positions in some U.S. states. Fanatics, Bet Fanatics is part of Fanatics is obviously well known to be trying to gain share too. It's not easy. ESPN Bet has low to mid single digit market share. Fanatics has a pretty low market share. It's not easy. So, I think that there have been waves of new competition, and you'll see. Look, this market is a big market. This market is a growing market, and it's getting bigger. And so we're going to see more competition over time. And so I think that moat is incredibly important that FanDuel has. I don't think it's easily replicable, not just with a big brand. You can't just do it with a brand. You have to do it with the brand plus the product. The product is key. DraftKings obviously also has an excellent product, which is why they have a very solid number 2 position behind Flutter. But those two, have proven that they are a cut above the rest when it comes to that product that isn't easily, like I said, replicable.
Brad, I'm curious, in your notes, one thing that stuck out to me or your recent note, is the M&A trends and how that has helped put Flutter Entertainment in the position that it's in right now. Looking ahead, and I could potentially get a little bit more color on this from the companies at Investor Day that's fast approaching, but do you expect that trend to continue? And I guess, what does that then tell us about the opportunities maybe within new markets?
Yeah. So one of the things that we really like about Flutter is yes, this global scale that they have, right? I mean, this is not, FanDuel versus DraftKings, and it's only been going on for a few years. Flutter has been doing this for a lot longer. They have a number 1 position in the UK. They have a number 1 position in Australia, these large, mature markets, and they know how to go into a new market. They know how to, through M&A usually, and they know how to deploy their own expertise in those new markets after buying a top brand, combining those 2 important pieces to get the best product and build the best moat. They've done it several times now. And so when we think about Flutter, we think about Brazil opening up, legalizing their market on January 1st in 25. We think about other big markets that are considering opening up. France is looking at internet casino, iGaming. And so, again, it's not even just a roll-up story, because a roll-up story doesn't give credit to the new markets that could and will likely continue opening around the world, creating total addressable market essentially overnight. Flutter is the best position to tackle really all of those new markets.
All right, Brant, we got to leave it there. Thanks so much for joining us, Brant Montour over at Barclays.
Thanks all.
Well, earlier this week at the 2024 Goldman Sachs Communacopia Technology Conference, Yahoo Finance's Brian Sozzi sat down with a firm's CEO and talked about the company's plans for growth in the year ahead. Take a listen.
Yahoo Finance is continuing its coverage at the Goldman Sachs Communacopia Conference in San Francisco, talking all things tech, media, but let's stay focused on tech right now. Bring in Affirm founder and CEO Max Levchin. Max, good to see you again. It's been another year in the books. I think I just saw you here, but nonetheless, we're here again. What is the state of your business?
It is great. We just reported our final quarter of fiscal 24. We killed it. We grew north of 30% on GMV, north of 45% on revenue for both the quarter and the year. And we made a public commitment to get GAAP profitable in fiscal 25. So firing on all pistons, just growing and making money.
I've been talking to you, I think since pretty much the founding of the company, but it feels like the past 2 quarters, something has clicked in the business and has entered a new gear. Are you entering a different chapter?
No, not to be overly self-critical, strategies remain the same. The mission has remained the same. The core values have remained the same. The executive team has largely remained the same. I think what I figured out is how to talk about our business so finally investors and others can understand what we're up to, but we've always done exactly what we said we would, and it's always worked for us.
Do you still see yourself as BNPL?
No. The one thing that I wish I could rewind the clock on is to not use those 4 dreaded letters in our S1. We're much more than BNPL. We are payments first and foremost. We're financial services. We have this deep relationship with consumers. We serve 300,000 merchants that are actively transacting with us. There's a lot to us than just BNPL. In the moment, it seemed like a cool acronym to get behind. It is now one of many things we do.
That's interesting, because I talked to Robinhood co-founder Vlad Tenev, and his company's gone through a metamorphosis too as well, focusing more on wealth management, trading, of course. But I mean, is your company, is it fair to say it's just matured, but in a good way? Obviously, you're still growing, but there's something else going on here besides from looking back to when you started the company.
We're definitely moving from startup mode to growth mode, for lack of a better term. For a while, I think we took growth for granted, and we're just trying to keep all the balls in the air and build systems and processes to ensure we can deliver on the promise we represented. At this point, we know how to plan, we know how to keep our eyes on the current quarter or the current day, but also make real plans to win in our market 5 years out, 10 years out, 30 years out. So we think of ourselves as a forever company. And I think for a long time as a startup, you say that, but you mean let's survive another week. At this point, it's very real, where we're thinking, what will this thing look like 20 years from now? And I hope I'm here to run it then, but
you will be. Well, what does it look like 20 years from now?
You know, from the very beginning, we said we're trying to build a modern answer to American Express. I admire American Express greatly. I think it's a wonderful brand. It's a great service to its consumers, but it is a club, and a club with a velvet rope, and you gotta be good enough to be on the right side of the rope. I wanted to build a payment system, a payment network, reach merchants, serve consumers, offer access to credit, but for everyone, for anyone who wants to be a part of something that stands for no late fees, no deferred interest, real transparency, real pro-consumer attitude, helping people get the things they want without having to get into debt that they can't repay. And that's what we are today. That's where we got to. So this is the state of affairs now. The next few steps are just get bigger, just get more services, more consumers, more merchants, etc.
What makes you so passionate about what you do?
I'm generally a passionate guy. Just talked about cycling. I can talk your head off on that topic too. I love financial services. It's the largest market, I think, in the world. Everyone eventually has to buy something or sometimes sell something. It's the market that, if left to its own devices, devolves into all sorts of gotchas and gimmicks and squirrely behaviors, and no one ever talks about how much they love their bank. No one ever talks about how much they think their credit card is on their side. They sometimes talk about points, but they never say, this is the real deal.
I've always thought of you as living in two worlds. Now you're doing financial services, but I mean, look, I grew up following your career when you were early days of PayPal, and you're very plugged into AI and the tech scene. I mean, we're here in California, and we might get an AI bill. You know, do you support that, and do you think AI is that big a risk to society?
I think there are two ways to think about AI, and I think I said this exact thing last year, so stop me if you heard this one before. There's techno-optimists and techno-doomerists. I made that one up, but you know what I mean.
It's good. I like it.
It's catchy. I'm a techno-optimist. I think the future of AI, as far as I can see, and that is what we're doing at a firm, is more productivity. We don't need to lose jobs. We don't need to cut heads. We don't have a plan to eliminate 700 jobs because the robots will do it. We're going to give a robot, or more than one robot, agents as they're now being conveniently called, to all of our customer service folks, and our engineers are going to get pair programmers that can help them be more productive. We use a lot of AI today in just running of the enterprise, and we expect to do a lot more than that. None of it is threatening. All of it is more productivity. The AI doomerism is all about, well, first thing, I'm going to harvest some of that free labor and fire all these people. That's a shorthand for saying, well, and one day someone's going to show me out the door because a smarter AI will do my job, and I just don't want to live in that future. I intend to build a former.
Do the models themselves that others are working on, are those a risk as they ingest more information and spit it out in whatever form?
You know, there are risks associated with AI, less to do with the models themselves and more to do with what the models are allowed to do in the real world if left completely unsupervised. And so I'm not diminishing or dismissing the need for controls and model governance and oversight and thoughtful rulemaking even. I would just not want to shut it all down, to quote another AI doomerist I'm familiar with. we are looking at one of the greatest new inventions of our time. Like, this is the sort of American Prometheus is a great book about the nuclear age, and it mostly played out to our advantage. Nuclear energy we get today is a marvel we didn't anticipate at the turn of last century. We should treat AI in a similar fashion. It can go wrong if we let models, especially poorly trained ones, ironically, go and do things to see what happens. But I think mostly it will just do amazing things for us, just like nuclear power stations provide power in places where you can't get it in other ways. So I'm optimistic, but also pragmatic.
Thanks to our own Brian Sazi for bringing us that interview from the Goldman Tech Conference. Now, coming up, we got some trending stories for you. We're talking OpenAI's valuation, that spacewalk, and more value meals from McDonald's. That's next, right here on Catalysts. Let's take a look at 3 trending stories today. First up, OpenAI receiving a new hefty valuation of $150 billion. This is according to a report from Bloomberg. The company is reportedly in talks to raise $6.5 billion in a round led by Thrive Capital. Not necessarily a huge surprise, given the fact that OpenAI very much is and viewed by the market, by Wall Street, as a leader within the AI race right now. So, of course, with ChatGPT really putting the spotlight on them, their partnership with Microsoft. But I think when you look at the amount of money raised, one of the big takeaways for me was what maybe this ultimately tells us about their going public plans, and maybe this could further delay it, allow the company to stay private for longer, which you could view to be very welcomed here, especially given the uncertainty right now. Yeah, I think this is why there's also so much focus on private credit right now, obviously for a million reasons, but AI in particular, we're seeing a lot of these companies continue to stay private amid higher interest rates, valuation questions, a ton of factors. But this was something that came up a lot at the conference, the idea that these AI plays, as soon as they go public, you're going to see a hockey stick response to a lot of these names, given the interest in AI and, of course, the potential impact. Also, another story we are looking at, SpaceX astronauts conducting the first ever commercial spacewalk this morning. 2 crew members on the Polaris Dawn mission tested their suits out in the dark vacuum of space. And tech billionaire Jared Isaacman leading the pack. He actually was the one opening the hatch this morning, exiting it at first. You can see him right there, I believe, on your screen. He, of course, was not the only one going into space. We also had a SpaceX staffer, Sarah Gillis, going out into space this morning than usual. Typically for the professionals out there, it's about 8 hours. This morning was just a couple of hours, but I mean, you can see in that image just a beautiful, obviously, I imagine, life-changing moment to be out there.
Yeah, to say the least. I mean, just looking at the pictures, I'm nervous for them doing this. But again, this is just a huge milestone for SpaceX specifically. When you talk about ultimately what this means, just the ability, and if it is successful, this entire mission, what this tells us, or the positioning that this puts SpaceX among some of its competitors right now. They're wearing the SpaceX designed and manufactured suits that were previously untested in orbit. So a successful trip here clearly could put them even more so in the leadership position. I believe this mission is expected to last about 5 days. So they might not return until, I guess, Sunday. That would put us at. But again, it's amazing. Yeah. And you have to give them lots of credit for even just their bravery.
Yeah, and Jared already said, we've got a lot of work to do back home, but it was incredible being out there. People talk about that Blue Earth thing where you see it and it changes.
I'm good watching it on the screen, but it is certainly amazing.
Same impact, yeah.
All right, let's take a look at our last trending story, and that is McDonald's. Its $5 value meal sticking around for longer. The fast food chain is extending it through December in most U.S. markets, all part of the company's strategy to bring in more lower-income consumers. And I don't even think it's lower-income consumers at this point. When you talk about the fact that obviously so many Americans have been struggling to deal with persistent inflation, sticky inflation, they're opting for those value promotional deals. And many people, even at the higher end, are going down and saving where they can and opting for these value meals.
Absolutely. And I think this is a trend that we've seen be really effective at the likes of Target, decreasing prices over the course of the summer. My big question is whether or not it's going to come up in the inflation data. Will we see some softening of prices across the board? And could that lead to a little bit of the deflation that the Fed has been seeking and that all of us, of course, are seeking as well? All right, well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, zooming in on your investment portfolio, we'll talk about how to broaden out your portfolio beyond technology and how to become a 401k millionaire. We'll talk to a financial advisor about the best moves that you can make to maximize your retirement savings. Plus, searching for a new job? We've got you covered with our weekly career tips segment. Today is all about building your network out, relationships, and navigating AI in your search as well. But first, before all of that, let's take a look at some of the market action 90 minutes into today's trading activity. Stocks, little change this morning after a fresh read on inflation. Wholesale prices, they came in a bit hotter than expected last month over month, but showed growth moderating significantly on an annual basis. Traders are increasingly pricing in a 25 basis point rate cut from the Fed next week. So let's talk about how all of this is going to affect your investments. Here with more, we've got Andrew Cray, who is the co-chief investment officer over at Crescent Grove Advisors here. Andrew, thanks so much for taking the time here with us this morning. So as all of us are staring down these next few trading sessions, all eyes are in focus for this Fed FOMC meeting. And so for the meeting that is anticipated to yield a 25 basis point rate cut, how might that impact people's portfolios?
Sure. I think if we look at where we've come from in terms of the narrative and how this has played out ahead of this Fed meeting, I think it's sort of important to keep that in mind. This big shift towards the labor market data, right, as opposed to the inflation data. In fact, this week, sort of the lack of fanfare around CPI, the lack of fanfare today around PPI is telling that there's been such a focus on the labor market and what that then portends in terms of the trajectory for the economy. If we're seeing unemployment tick up, ultimately, is that a signal that the economy is weakening, that we're headed towards a recession, that the Fed needs to act more quickly? I think that was sort of top of mind for investors. And as you evaluate the outlook for corporate earnings. But for us, if we kind of take the mosaic of data that we've seen, whether it is looking purely at the labor market, which we think is just more softening off of an ultra hot level, but then you look at corporate earnings, what we saw last quarter in terms of earnings growth, still very solid from that perspective. If you look at credit markets, which are usually an early indicator of stress, broadly speaking, in financial markets, pretty quiescent, all things considered. We just sort of take the totality of information and think that perhaps this last little bit of volatility that we've seen over the last several weeks here is a bit unwarranted, given again everything that's going on. We think is a pretty favorable backdrop going forward for markets.
Yeah, it was interesting because the markets were trying to see whether or not, or at least game out whether or not they should have been paying closer attention to CPI. We did see an early morning dip off of the print yesterday, but then we saw markets rally back after that and ultimately regain some control of the emotion that seemed like it was in the tape. And so all of these things considered, where are the strongest sectors that people should be positioned for or positioned in when the rate cutting cycle does begin and when we ultimately get some type of sense on what the terminal rate will look like?
Sure. So we think we would kind of frame it in terms of tech versus everything else in this environment, right? And this kind of goes back to blocking and tackling portfolio management in some respects, where you've seen these tech names, these mega cap growth names in particular, the Mag 7, do so well over the last 12, 18 plus months in particular. And warranted in the sense that their earnings growth was far superior to the rest of the market. But as you look out now over the next 2 to 4 quarters in particular, you look at the sort of broadening of earnings growth, this trajectory now for the S&P 493, if you will, kind of the rest of the market to catch up. And in particular, some sectors like healthcare, like financials, industrials, some things that would be more traditionally thought of as kind of value type sectors. The forward-looking earnings growth expectations there are starting to look a lot more favorable, and you're starting to converge with these tech names, which we think presents an opportunity. Alongside it, you've got a much less demanding valuation backdrop for those sectors, right? So I think you point to that and you say, okay, some of the exuberance and enthusiasm, if people are rotating out of those tech names, taking some chips off the table, where do you go? You look at these types of sectors that I just highlighted.
We also just got an ECB rate cut for the second time here in just about 3 months, essentially. And so with that considered, I bring that up because there are also investment opportunities outside of the U.S. that you've been looking towards as well. Where are those more pronounced opportunities that you would be telling investors to really consider for their portfolio?
Sure. And a lot of that comes back to, again, US versus non-US is effectively a tech versus everything else type of bet in many respects. And what you see is historically, non-US stocks, they kind of follow the cyclical type pattern. Every 18 to 24 months, you see business cycle dynamics play out. And right now we're sort of at a trough or coming off of a trough, let's say, with manufacturing activity, export activity, global trade. So if you start to look at some of those early indications of if the trade cycle is going to inflect higher, it's starting to look reasonably positive. So to your point, we would look at areas like Europe, which hasn't had the most flattering data prints recently, but they do have the ECB providing some support in terms of lower rates. And then you are seeing some, sort of inflection points, again, looking like an improving economy or sort of dynamic around exports and the cyclical portions of the economy playing out. And then you look at Japan and you look at things like emerging markets ex-China. We'd sort of set China to the side. But all these different dynamics point to us in a direction that say that cyclical picture is playing out, and you've got much less demanding valuations. Again, I come back to this theme because you've got these mega cap tech names which trade at pretty rich valuations in this environment. Is there an opportunity to make that relative value rotational trade right now in advance of this sort of inflection point playing out?
Andrew Cray, who is the co-chief investment officer at Crescent Grove Advisors. Andrew, thanks so much for taking the time here with us today.
Thanks for having me.
Certainly. Coming up, everyone, plan on being a millionaire by the time you hit retirement? That's the big question. I sure do. We've got some tips to help make that happen next so we can all get to that marker. And all later on in the show. Hey, watch me make some jelly. I got the chance to spend some time with the CEO of J.M. Smucker as part of our Lead This Way series. You do not want to miss it. There are more 401k millionaires than ever before. According to new data from Fidelity, there are now roughly 497,000 401k plan participants with balances of at least $1 million in their accounts. So, how can you set yourself up to be on the path to be a 401k millionaire yourself? Here with more, we've got some of those tips. Tracy Burns, who's the UBS financial advisor, joining us here. Tracy, great to see you again. So, I think first and foremost, people just want to know, okay, am I part of that number? And if not, how do I become part of it? What are some of the first steps that people can take to set themselves up to be a millionaire by the time they're ready to tap in that 401k?
Yeah, Brad, it's all about consistency. You know, it's much like when you diet Monday through Friday, and then on the weekend you have pizza and potato chips and you wonder why you're not losing weight. It's the same thing. Slow and steady wins the race. And I bet you those 497,000 people put money in, left it there, put it in the stock market, checked on it, and let it grow. And I think that's really important too. Don't just like set it and forget it. Make sure you revisit, you diversify, you rebalance if you have to. What was good when you started working 20 years ago might not still work today, Brad. So you have to get back to it as well and pay attention.
And so with that in mind, what are some of the common mistakes that you see people making, Tracy?
So that's it, right? We forget all about it. We don't increase. I'll tell you, one of the number one things people could do is when you get a raise, give your retirement plan a raise as well. Bump it just a little. Bump it in accordance. Set the percentages, as a matter of fact, to increase with your salary if you can. I would also say that one of the worst things and the hardest things is that people make withdrawals before retirement. And you can, right? It's your money. Try really hard not to. You can for first-time home buyer. You can for hardship. If it's possible not to touch that, leave it alone. And lastly, don't forget that match. If your company's offering you money, you better give till you get it, because it's free money and it's yours, and it will add to that million down the road someday.
What's a good investment rule of thumb for contributions to that 401k as well here?
It's really hard to say, right? If you live in Manhattan and you're just out of college, it's so hard to say, oh, by the way, you should put the max in because you can't make rent. So I get it. I say you just try really hard to pay yourself first. But I am cognizant of the fact that living expenses are tough in certain places. But ideally, you want to hit that annual number every year, because don't forget, you don't pay tax on it until you retire. So it is a help, paycheck to paycheck, to not have to pay tax on a portion of your salary.
All right. Tracy Burns, who is the UBS financial advisor, joining us here on Wealth. Tracy, great to see you. Thanks so much for the time and insights.
You too, Brad. Thanks.
Thanks. Well, ask anyone applying for jobs right now, and they will all tell you the same thing. You spend time crafting your resume and the perfect cover letter only to have an AI tool disregard, potentially, your application, and the hiring manager never even sees that you applied. And according to a new report from Workday, 77% of organizations plan to increase use of an AI tool in hiring in the upcoming year. So, how can you gain an advantage over the competition in this new landscape? Well, here to help, we've got Ileana Goldstein, who is the founder of Ileana Goldstein Coaching. Great to have you here with us in studio.
Great to be here, yeah.
Okay, so first and foremost, I mean, why are so many employers and potential employers tapping into AI tools to really help them weed out and perhaps qualify certain applicants too?
Well, as I'm sure you discuss a lot on this show, we're obviously in a time in the job market where, from a job seeker's perspective, there is just not a lot of availability out there, but there are quite a lot of people looking. So it's a bit of a supply and demand issue, which means that when jobs are getting posted, there are so many people applying for those jobs. And as a recruiter, it's virtually impossible to be able to go through all of those. So AI is obviously very helpful from an efficiency standpoint, from being able to really weed out people who are just not a fit, and will help just in streamlining the process for them overall from that perspective.
How do I make sure that I'm not a weed that gets tossed out of the pile when I'm trying to throw my head into the ring for this position that could be a dream job, could be a pivot, but know that AI is going to be looking for certain things in that application?
Yeah. So, I mean, the irony here is that in order to avoid being tossed out by AI, you need to be using AI yourself. So very simple things like taking the job description, throwing it in a chat GPT to pull out the relevant keywords, to ask it to highlight what are the top 3 to 4 skills that I should really be emphasizing in my resume, right? All those kinds of things are going to help. Using it to help prep for interviews, for phone screens. There are so many different tools that AI can use. It can also just help you be more streamlined, again, be more efficient, whether it's the types of emails that you're sending from a networking perspective, helping you do that and just build those efficiencies into your job search. So leveraging it as your own tool will be very helpful.
There's a lot of people trying to build out their network as well right now. And this is incredibly important just to identify opportunities that might not even be posted yet or know where the murmurs are about where teams are looking to expand. How can people start to make sure that their network is set up for their pivot that they want to make or just for that next gig that they're looking to get?
And the funny thing too is we talk about AI and we can use it, till the cows come home, but in the end, it's not going to be anywhere near as helpful as having that established network, right? That's the number one tool. So when we think about really developing that network, number one, think about the low-hanging fruit, right? People that you're already connected with, but don't stop there, which is where most people stop. It's about facilitating and developing a new network. So using tools like LinkedIn to identify people in the roles and at the companies that you want for yourself. Of course, just being okay putting yourself out there. This morning I was in a mom group that I'm in. I saw that one of the moms posted, hey, my husband's trying to get a job at Spotify. Do you know anybody here, right? So you have to be willing to put yourself out there and potentially be rejected, right? You're not always going to be met with a response, but that is the best way to cultivate that network. And then even when you are actively employed, making sure that you're still doing that, right? The best thing to do is to put yourself in a position where you have all these connections so that when you're thinking, I want a new job, you're not starting from scratch, but you're tapping into all the people that you have really been maintaining while actively working. So all those things are going to be very helpful.
Yeah, great tip. And shout out to that mom for making sure that she's tapping into her network as well. And husbands, we got to do that. And husbands out there, I should say, y'all got to do the same. All right. So all these things considered, prepping for a pivot. A lot of people trying to figure out, all right, if my job right now could be at risk of not having as much of the requirements as it does because there's a new technology or it's just a changing environment or maybe I'm just interested in something new. How can people prep for their pivot as well?
So I think one of the biggest mistakes people make when prepping for a pivot is that they kind of just start going and taking action before they even know what they want to do. And if you are pivoting, you have to be able to really brand and market yourself for that and be able to highlight those transferable skills. And one of the best ways to do that is to first niche down on what it is that you want to do. So I really encourage people to think about where have I been the most engaged in my career and in my role thus far? And within those areas, what are the skill sets that I'm using? And then where can I take these skill sets and transfer them elsewhere? And once you can really nail down that specific title that you are looking to pivot into, then we lean into all the networking strategies, then we lean into AI to really customize our resume and our LinkedIn, and we can go from there. But you gotta get clear on what you want and not spread yourself across a lot of roles. Focus really seriously on one specific role.
Just lastly, while we have you here, I'm looking at my inbox, and I have a meeting request. Okay, finally, I've gotten that opportunity to speak with either a recruiter or a hiring manager. How can I stand out in the interview?
So this is a big one that people overlook as well, your elevator pitch. It's one of the first things you will be asked, tell me a little bit about yourself. Everyone glosses over it or goes on a 5-minute tangent and you completely lose your interviewer at that point. You have to really prep that. I recommend at most 2.5 minutes of speaking at that point. Break it into sections, overall overview of who you are, what are your notable accomplishments, things like that. Why are you excited about that role? So ace that intro and then also close it with really good questions that other people aren't asking. Those are 2 really good ways to start and close the interview.
Eliana Goldstein, who is the Eliana Goldstein coaching founder, joining us here on set. Thanks so much for taking the time.
Of course, thank you for having me.
Certainly. Guys, coming up, how expensive are your groceries really? I talked to a former USDA economist about this next on Wealth. High prices, especially on food, have been a source of concern for consumers since the pandemic ended. Now, in the latest CPI print, we saw food prices moderating with groceries unchanged on a monthly basis and up just 0.9% year over year. Still, shoppers are feeling the pinch. In the latest Conference Board Consumer Confidence Survey, they mention of prices and inflation topping write-in responses. So, why is there such a disconnect between prices and how consumers feel? Joining me now with more is Richard Volpe. He is a former USDA economist and professor of agribusiness at California Polytechnic State University. Great to have you here with us. You have been looking across the consumer realm and really trying to get a sense of the mindset right now. Where, to your estimation and from what you've been able to analyze, is food inflation sitting at right now in this broader cycle?
Food price inflation is down. So we saw in 2021 and in 2022, we saw food prices increase at a clip that we hadn't seen in the US since the 1970s. And understandably, that's been challenging for a lot of households, especially lower income, more price sensitive households. But that rate of inflation has slowed. In many cases, it's actually flatlined, for many food categories. However, food prices, nominal food prices, have not come down. And you mentioned sort of in your lead up, you mentioned that disconnect. And I think that's the number one source. I think we see these headlines and they say food, inflation cools, CPI inflation cools. That's good news for consumers. And then consumers hope or expect that translates into seeing food prices coming down. But that would really be sort of counter to the norm in the US and in most developed economies to see actual nominal deflation. And that, I think, is the number one source of sort of that confusion, disconnect, and lingering frustration among many.
Where within the perhaps basket mix would you expect prices to continue to decelerate or even decline and quicker than and relative to other parts of the basket?
Sure. Yeah, it's actually easier to talk about the places where we're still seeing challenges. But in terms of inflation, we're seeing a lot of relief with fruits and vegetables and with a lot of center aisle foods, a lot of bakery goods, breads and cereals. There are still several, protein sources where we are seeing relief. But that said, some of the biggest challenges, which are prominent in the minds of many consumers, we're seeing food price inflation remaining strong for beef products, for pork products, for eggs, and we're still seeing some challenges with the fats and oils, the butters and the margarines and the oil-based foods there. So those remain outliers, and those are the few areas in this market where we do still see inflation even stronger than that historical average.
You mentioned that food prices have been more volatile in the last 15 years. Why is that? And how do consumers navigate that reality?
Yeah, there are a lot of reasons for that. It's really interesting, and food price behavior since around the turn of the century, around 2000, there really was sort of a sea change in the way food prices behaved. If you compare sort of the late 80s into the 90s, and then right around 2001, 2002, a lot of reasons for that. But I like to point at a few specific factors. I like to point at a major increase in the sort of volatility and inflation of upstream energy costs. So we've seen crude oil, for a number of reasons, behave in a way that's far more erratic since around that time. And of course, energy prices, the whole food supply chain, not just retail, not just what consumers can see, but the whole food supply chain is very, very energy dependent and energy intensive. We've seen a number of challenges arise with respect to labor in the last, say, generation, labor availability, turnover, people moving into jobs in other sectors. We've seen some persistent upstream commodity challenges going on. And then more recently, say since, in the last 10, 15 years, we've seen refrigerated truck transportation in the U.S. become a major challenge. We've been dealing with driver shortages. We've been seeing truck rates increasing, especially in the long haul. We've seen uncertainty in the availability of carrying capacity in refrigerated transport. And that has also been a factor that's been driving volatility, especially in the last 10, 15 years or so.
It's interesting, and I'm looking at a Deloitte survey that came out with some data saying when it comes to deciding between either fresh or convenient food, ease often wins. And that ease can also mean some impacts or at least trade downs to some of the store brands or retail brands as well. How do you expect that mix to essentially play through and into the mind of the consumer when they're going through grocery aisles?
Yeah, that's a fantastic question. And the way I would sort of first, I guess, respond to that is I actually think we've seen the retail sector, especially since COVID, I think we've seen grocery stores all across the U.S., ranging from single store operators up to some of the biggest players, the national chains, responding to sort of that increased demand on the part of consumers. So, COVID-19 obviously changed the game with respect to where people buy their food and the food and how they prepare food and all those and who they're eating with. And grocery stores have responded across the board by increasing the availability of, when we think ease, a lot of people think, oh, well, center aisle, a box that I can open or something I can just add water to. But I think especially in this modern economy in these last few years, we've also seen this sort of experiential demand increase. And we've seen a huge increase in the availability and proliferation of ready-to-eat, prepared foods, ethnic foods, the sushi, the soups, the fried chicken.
Right.
And consumers have a strong demand for these foods. But it's worth pointing out, when consumers purchase these foods, they're outsourcing labor, right? They're outsourcing the inputs and the labor required to make those foods. These foods tend to be higher cost and higher margin. And it's not exactly, I think, what you asked, but I do want to point out that the availability and demand for those foods, it's a major reason why we're seeing relatively strong profitability among a lot of retailers, because they perceive this demand and they're meeting it, and consumers are increasingly shifting even their sort of convenience experiential budget, in some cases away from the supermarket, away from the restaurant and towards the supermarket.
Interesting. We got to have you back to continue this conversation. You're going to be a really important point that we continue to hear about, even leading up into the election, which we didn't get to, but we'd love to have you back. Richard Volpe, who is the professor of agribusiness at California Polytech State University. Maybe we'll just come out there. Seems like it might be better weather anyway.
It is beautiful. Thank you very much.
Thank you. Let's pivot here, steering the wheel, so to speak, to the auto space. Yahoo Finance behind the wheel took the 2024 Cadillac Lyriq EV for a spin. Praz Subramanian and Rick Newman are here now to tell us about their test drive. I love you guys' ride-alongs, by the way.
You got to come once.
Look, just throw me in the back seat.
Get him in the car.
All of these cars that you're driving have back seats, and I get no invite. But tell me about this and the Cadillac Lyriq. What were some of the takeaways here?
So I'll start with the design. So I thought that when I first saw it, it was pretty impressive. I mean, I've seen a lot of these cars right now as Ubers and high-end kind of livery, and it's actually kind of bigger than you think. It's more striking than you think. It's very adult. It's not maybe not necessarily my style, Rick, but I thought it looked quite nice on the outside as well as the inside, which you get a chance to take a look at too.
Yeah. So I'm going to bust you here, Praz. So the first thing Praz told me about this car is it looks like a taxi or an Uber, and I was like, what? So you get the best Ubers in town, I guess, right? I don't know. I was like, I think it looks distinctive, and doesn't mean that I would necessarily want to buy it, but I love cars that look different, and it's really hard to make a car that looks different. I mean, there are some out there. Rivian has got that interesting headlight alignment. The new Ford Bronco looks pretty cool, but it's very hard to make a car that looks different.
Before we get into the good stuff, I want to point out some bad stuff here, Rick. You are actually fumbling right now.
I'm really struggling.
And you had a problem with that, right?
It's just overcomplicated. There's so much going on in cars these days, especially luxury cars where they just have to cram in every possible thing. So we have one clip where you counted I think you counted 15 buttons just on the steering wheel alone. Those are the shortcut buttons.
Yeah.
And I had trouble pushing. There are different types of cruise control: regular cruise control, smart cruise control. I thought I had one. I had actually pressed the other. The car didn't slow down. There's too much going on. If you own this car, you're going to figure it out, and you're going to sort of get the settings customized to your liking. But there's a lot.
And then real quick, so we drove the car. We drove the car actually.
Yeah.
And we actually liked it. I think top 3 for me. Obviously, good design, good interior space, but it drove well smoothly. Even the rear-wheel drive car with one motor in the back, I thought had good power. I think it's a winning package.
Good execution. I mean, Cadillac is building good cars these days. I mean, people might think this is kind of a tarnished brand. It's building good cars. But I also feel like this is a test bed, and this is a little bit geeky, but this is the first time they're using this so-called Ultium. They're trying to brand their battery pack. It's the Ultium battery pack, and there are going to be a lot more vehicles coming with this Ultium. So this is sort of the first big launch with that. We're going to see more of this.
And so this pricing, because I think I saw this at the U.S. Open, which typically you see car manufacturers go to an event like that.
Like big sponsor.
Right, to try and make sure that they're drumming up that luxury demand as well. I mean, is this luxury pricing or is it fair pricing for a luxury vehicle?
So real quick, it starts at $59,000, 59. Ours was around 70 something with kind of with the goodies.
Price demand's the best.
But Rick, we're looking into real quick. The leasing is where it's at for this car.
Yeah.
Massive deals for leasing because there's a lot of them out there, and they get that tax credit for it.
That's right. And so you're going to see more Cadillacs. So I think what's going on here is the electric ones all end with a Q.
Yes.
So this is the Lyric, ends in a Q. Mm-hmm. We've got the I call it the Optique, but you tell me it's the Optic.
Optic.
What's the other one?
The Vistic.
And then way down, and then there's a supercar called
the
They all end in Q.
That's way out. Okay. Pras Subramanian, Rick Newman, thanks so much. I'll be waiting for my invite. I mean, I sit right behind you, Pras, so hopefully I'll get that next invite for the Celestic or whatever we're calling them with the Qs now. Yeah. Thanks so much.
Yeah.
Appreciate it. Much more on wealth after the break. You're watching Yahoo Finance. The holidays are right around the corner and many Americans are looking to spend. Deloitte's annual holiday retail forecast shows retail sales are likely to increase 2.3 to 3.3% compared to last year. Joining us now is Deloitte Consulting's retail and consumer products leader, Michael Jeske. Michael, great to have you here with us on Wealth. First and foremost, I mean, you think about some of the anticipations going into this holiday season. How does this also kind of mirror up against what we've been tracking, which is a really battle-tested consumer, as prices have certainly come into play on both staples and some of the discretionary items?
Yeah, well, good morning, and thank you for having me on. I think you summarized it pretty well, that it does line up against some of the battle-tested consumer. What we're forecasting is a more normal return to growth and a moderated return to growth as opposed to what you've seen over the last few years. So when we look at our economic forecast, we're looking at, you mentioned, the 2.3 to 3.3% growth. That's very much in line with what we've seen historically over the last 10 to 15 years, and that's where we think we're going to be returning to.
So is that normalization? Are we just getting back into normal holiday seasons?
Yeah, we are seeing more of a normal holiday season trend, and you're seeing a variety of macroeconomic factors that are influencing that, but all net out to what you've seen historically pre-pandemic.
And so with that in mind, where are some of these strongest categories that you're anticipating could potentially outperform?
Well, some of the strongest categories are the traditional ones you're going to see. Those, particularly on the retail side, those that have invested in the omni-channel and those that have built up capabilities to service customers through a variety of different channels. Those are the retailers that are going to exceed, and the categories that they have are going to be the ones that continue to exceed as well.
And on the other end, considering that this is the biggest slowing that we may have seen since, 2018, what does that kind of hold for some of the categories that may underperform, and how much there's going to be needing to be a sense of promotions or discounting that some of the retailers are going to need to put forward to move through that inventory?
Yeah, that's a question I get quite a bit. There's going to be a fair amount of the discounting, and it really relates to what's been happening with prices over the last few years. You know, inflation has been up and has driven prices up. It's come down. So inflation then turns into both a headwind and a tailwind for us. On the fact that it's come down, it gives more availability to spend, and so you can continue to be able to, the consumer is going to be able to continue to buy. On the other side of it, the prices have driven up. So some of the categories that get into more discretionary spend are going to still be tougher spends. That all relates to a lot of promotional environment, a lot of seeking value and convenience, and retailers really chasing that demand for the year.
It seems like for retailers as well, it's going to become even more of a focus to make sure that their omni-channel approach is clicking on all cylinders. And I bring that up as we're flashing on the bottom of the screen here, or we were a moment ago, some of the digital sales and online sales expectations there. How much of that are you expecting to really kind of offset some of the deceleration in growth in the in-store side?
Yeah, I think that dynamic is spot on. If you look at deeper underneath the forecast, it was 2.3 to 3.3% total growth. Within that, the online channels are going to continue to accelerate at a faster pace. We're forecasting a 7 to 9% acceleration there. And so to the heart of your question, those that have invested into their omni-channel capabilities, those that have really met the consumer of where they are and meet that e-commerce acceleration, those are the ones that are going to win for the upcoming year.
And then as we have you as well here, I'm thinking about the consumer propensity to look for those promotions as we were talking about, but also not just looking for promotions, but the amount of debt that they're willing to take on, especially knowing that we've seen the New York Fed already look into how consumers are spending, realizing that we've now hit a marker of more than $1 trillion in credit card debt. So what could we essentially see this get to after the holiday season if people are saying, you know what, I'll still spend, but I'm just going to put it on credit instead and figure out how to pay it down later?
Yeah, I think that's why we're seeing this come back towards a normal spending period, because of the facts that you just mentioned. Credit card debt is high, savings rates are lower. Those are going to be some of the headwinds that are going to prevent us from getting to that strong growth that we've seen in years past. Now, how consumers choose to pay down the debt afterward, that's going to be individual by consumer, and we'll be talking more with consumers in our October follow-up survey, where we talk directly to shoppers of how they plan to spend, in what categories, and where they'll be going.
Michael, we got 30 seconds left or less. Any tips for consumers out there shopping this holiday season?
Yeah, so tips are some of the standard ones. Shop early for deals, visit the stores, take advantage of all the investments that have been made in both the omni-channel, the online, and the physical retail. Loyalty, the loyalty programs are going to continue to increase, so take advantage of those. And then you're seeing the continued advent of free shipping and really meeting consumers where they are. So continue to use that to your advantage.
Michael Jeschke, who is the Deloitte Consulting Retail and Consumer Products Leader. Thanks so much for taking the time with us today.
All right, thank you for having me.
Absolutely. Coming up, I spent the day with JM Smucker CEO Mark Smucker as part of our Lead This Way series, and I made my own jelly. We'll bring you that piece on the other side of the break.
With a name like Smucker's, it has to be good.
This isn't the same JM Smucker brand from the past.
Is it crushable as a sandwich or a dumpling? I feel like it's a peanut butter and jelly dumpling. You know what I mean?
That just blew my mind.
The 127-year-old company has been refreshed by current CEO Mark Smucker, capitalizing on cultural moments and crafting ads for a modern audience.
Continuing to evolve the brands while still being true to their authentic heritage is really important.
Smucker comes from a long line of Smuckers who have turned what was once a family-operated jam business into a $13 billion publicly traded company. The JM Smucker Company has spread far beyond jelly under the leadership of Smucker's dad and uncle, a strategy the 54-year-old is hoping will spark a similar growth trajectory under his leadership. Yahoo Finance went to Orrville, Ohio to get an inside look at how this Smucker plans to take on the next 127 years. This former jam and jelly plant now serves as an innovation center for the company. Evolving products are key to success, according to Smucker. whether homegrown or part of an acquisition, like the company's latest, the 2023 $5.6 billion purchase of Hostess.
Our strategy is fundamentally about leading in growing categories. We had been studying Hostess for a couple of years and just really were impressed with the growth that they had achieved and wanted to understand why the consumer continued to look for indulgent treats, and there continued to be a long runway.
Before getting snapped up by Smucker, Hostess led the U.S. packaged cakes market with a 10% share, bringing in $1.3 billion in 2022. Transforming the business via acquisition isn't a new recipe for the company. Over the course of 17 years, Smucker purchased a range of businesses, diversifying its portfolio and increasing the company's stock 500% and positioning themselves as market leaders in multiple categories. Before acquiring Hostess, Smucker left a mark as CEO by refocusing the company portfolio and divesting its baking businesses.
We realized that our growth opportunities were far better served in places like coffee and K-Cups and pet. And so we made some very difficult decisions to totally transform and reshape our portfolio.
The company's stock hasn't grown under Mark Smucker's tenure in the same way it did during the previous generation's leadership. And while revenue is up under Smucker, it is certainly not alone in the massive consumer packaged goods market, with the likes of Nestle, General Mills, and Kraft Heinz elbow to elbow with Smucker on store shelves. The CEO is aiming to drive future sales by appealing to both modern cravings and modern culture, a model proven by Uncrustables.
This is the story of the best part of the sandwich and his crust.
In 2023, Smucker began its first national marketing campaign for Uncrustables since acquiring the brand in 1998, looking to capitalize on being in the cultural zeitgeist.
After 20 plus years, it's the first time that we've advertised because it's been all word of mouth, and we were just trying to keep up with demand. Now, what's been great about it is we've gotten all kinds of organic endorsements that we didn't ask for. We had Jason Kelce, we had Drake eating one on stage. We had, actually there's been a couple DJs in LA that have posted about them.
Smucker expects the brand to reach $1 billion in sales in 2026, up from $290 million in 2019.
Making our brands more relevant to things that are happening today is a way that we can connect those brands with today's consumer.
Long before Uncrustables, the J.M. Smucker Company began in 1897 as an apple cider and butter business. Created by Jerome Monroe Smucker, Mark Smucker's great-great-grandfather, the business has been passed down through 5 generations of Smucker CEOs, going public in 1959 to grow the business. J.M. Smucker lived on campus in this house built in 1907. The house is still used by the business today.
Jerome Monroe was a Mennonite dairy farmer, and he didn't really like milking cows, so he invented this large cider press. He started making apple butter with that cider press, which shortened the manufacturing time, and started selling them out of a horse-drawn wagon.
I think about coming into the business later in life, but I never really think about it as I'm the 5th generation. I think, well, yeah, my great-great-grandfather, J.M., started it, and it would be great to continue the same tradition.
Despite his last name and early involvement in the business, Smucker wasn't always gunning to be the 6th CEO. Smucker spent time working in South America and even teaching in Alabama before coming back to work for the family business, eventually overseeing the company's Canadian operations and the acquisition of brands including Pillsbury. Smucker describes the challenge of integrating a business 4 times larger than Smucker north of the border as a light bulb moment.
Trying to integrate those 2 businesses together, having to transform that business to a more branded growth business. The process of building that team and making those decisions, even the tough ones, made me realize that I'm really passionate, again, about the people and the brands. And that's what I care most about. And in order for me to really make a mark and build a legacy, if I can nurture the culture of our people and modernize these brands, that is really what's going to make this company great.
Modernizing the brands of a 127-year-old staple and institution can come with some internal resistance.
There always have been disagreements. We've done a very good job of keeping those disagreements behind closed doors and letting our employees see a united front. One interesting shift that took place is as we went about modernizing these brands, we had some very restrictive rules, self-imposed, about where we would advertise. We were very conservative in terms of the types of brand taglines or slogans that we would use.
That's why choosy mothers choose Jif.
Taking off those shackles was something that I think we struggled with as a family, but ultimately it was my decision and the decision of this team, and again, pushing these brands and connecting them to culture is really what catalyzed the growth over the last several years.
The business world was rocked today by the merger of the Peanut Butter Group and Chocolatey Corp.
Our brands had become maybe a little bit stale if you think about Folgers being maybe your grandmother's coffee. We had a responsibility to turn up the volume on some of these brands. We actually created a marketing model that is much more focused on the consumer and then making sure that the actual advertising is relevant in today's culture.
We got him.
Just like its Uncrustable strategy, Smucker is refreshing marketing across the board. This includes the company's most historic brands, once rooted in the past.
We have younger consumers. You now have Gen Z. Soon we'll be seeing Gen Alpha. Their tastes will change. And what creates an emotional connection between the brand and the consumer is often something that is newer.
Smucker also values new when it comes to the products themselves.
It's basically a lava cake. Okay. So this is brand new. This has just hit the shelves.
It's all an effort to keep a finger on the pulse of what consumers want.
The other brand that is going gangbusters is Cafe Bustelo. So Cafe Bustelo is true to its roots as an authentic Latino coffee, and all of the advertising is always bilingual. It's the fastest growing coffee brand in the coffee category right now.
Smucker has 3 major brands in the nearly $12 billion at-home coffee market. The company does coffee testing and innovation here in their coffee college.
How many cuppings, how many samplings do you do usually a year, ballpark?
It's a huge number. We think it's about 30,000 cups per year.
What started as a small business out of a horse-drawn wagon has grown into a portfolio of major brands with 9,000 employees across the country and in its home of Orrville, Ohio.
As you think about the future of the company, what's the next 5 to 10 years look like for Smuckers?
You know, our strategy is super clear right now. It's, owning and marketing leading food brands and growing categories. And we've, again, gotten so focused over these last 5 years by selling some brands but acquiring new ones like Hostess. We would like to continue that journey, growing this amazing portfolio of brands and hopefully adding to it at the opportune time in the next 5 years.
And be sure to catch the extended cut of my conversation with Mark Smucker on Yahoo Finance's YouTube channel. That's it for Wealth. I'm Brad Smith. Thank you so much for watching. And stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You don't want to miss it.